If you self-define yourself as a victim that this system's built against you, unfortunately, victims don't come out ahead.
I think we're seeing the consequence of elevated volatility.
Because I think anybody can be wealthy, but it's going to require discipline. You living on less than you make, you using that margin to actually create the money that then gets invested. And anybody, if you give it enough time, can be a millionaire.
What are some of the biggest mistakes that you've seen people make?
Whether you're a 20-year-old or you're a 60-year-old, if you don't have discipline, it's going to be very, very hard for you to be successful financially. That's why we see so many professional athletes who sign these huge contracts, have these huge salaries, and end up broke.
Do you think that that's on purpose?
Consumption is profitable. Selling you stuff is profitable. It's creating people who are independent and know how money works, it's not as easy.
Should investors be worried about how much the market is now dominated by AI?
The market has a way, at least in my experience, of making us all, even the smart ones, look like fools.
Brian and Bo, thank you so much for coming on the Iced Coffee Hour. You guys manage about $2.2 billion worth of money for your clients. You guys are both certified financial planners, CFA, CPA. You guys are the real deal. And at the end of the episode, we want you both to react to Graham and my investment portfolios. I think you guys are going to hate how I'm investing my money. But before we do that, Graham has a question.
I want you to react to this clip because you focus a lot on retirement and saving. And Elon Musk just said that saving for retirement right now is pointless. Here's exactly what he said.
One side recommendation I have is don't worry about squirreling money away for retirement in 10 or 20 years. It won't matter.
No.
Okay.
Either we're not going to be here or
it just you won't need to save for retirement. If any of the things that we've said are true, saving for retirement will be irrelevant.
So I think the context behind that clip is he was saying that artificial intelligence is going to advance to the point to where there's going to have to be some sort of basic universal baseline for everyone.
And also, I think because I've followed enough of what Elon says, is that he thinks because of all the breakthroughs that are come, is things are going to become so much cheaper.
Because they're so efficient.
That you're not going to have the need for the way we think about money currently.
And so I think if you want my reaction, okay, we could move in that direction and he could absolutely be right. And so what do you end up with? You end up with a lot of people that saved a whole bunch of wealth, that were prepared for a thing that perhaps they did not have to be prepared for. But he's saying 10 or 20 years on the line. What's the other side of that coin? The other side of the coin is it doesn't manifest exactly the way that he says. The grasshopper did not store up for winter. Winter ended up showing up, and 20 years on the road, you're like, whoa, I don't have any money. I don't have any savings. I don't have any retirement. Elon told me I wasn't going to need it, but I got there and now I need it. Which one of those is a worse outcome? I sacrificed a little bit of today that I guess I could have been living it to the full, or I actually get to retirement, get to the place where I want to not have to work anymore, and I didn't do the stuff I was supposed to do to be able to actually retire.
I'll put some context with it is that, now, fortunately, and we see it with our clients too, 80% of millionaires are first generation. But I've been doing wealth management long enough. I've had a few people come across my path to where they're waiting for their parents to die because they know there's significant wealth when their parents, die and they're going to inherit this money. It's the saddest thing in the world because, do you want to root against your parents? And I think that's what he said, in 10, 20 years, do you really want to kind of lay all of your is tying into what Bo's saying. I'm too self-determining with my life. And I also know the secret to success is if you start early and often, time is your most valuable resource. So maybe get excited about the dream that Elon's putting, but don't build your life off that. Just like I would never tell anybody build off of your parents' inheritance. I don't come from money. Bo doesn't come from money, but it's just a good case study on you need to be more self-determining with your success and be disciplined and make something happen. That sounds like something to kind of get excited for or to fear, but it's more to get people excited. Elon also has a tendency to really throw the world at you and get you excited, and then it takes a while for it to actually come to you.
Well, speaking of savings, we got some really scary statistics that just came out. A personal savings rate that just hit a low of 4%. Nearly 40% of Americans have less than $500 in savings. Yep. 70% of Americans are living paycheck to paycheck. Gen Z is at 72%. And the average American carries about $6,500 to $6,700 in credit card debt personally. Why do you think people are saving so little?
Yeah, I think You can obviously talk about the outside factors, right? Housing has gotten more expensive. Cost of living has gotten more expensive. Inflation is a thing that we have been dealing with over this past couple of years. But what's really, really interesting, even though that savings rate hit quote unquote an all-time low, it's been low for a long time.
That's what I was going to say.
Right? It's not like it's like we were saved. The only time in the last 20 years we've seen an uptick in savings rate, you know what it was?
2020.
It was 2020. It was
that
during
free
COVID.
money.
Because nobody could go out and spend money. And it's amazing how much money you can save when you can't go spend on anything. And so I think what we're seeing right now is more of a continuation of bad behavior that's gotten slowly and slowly and slowly worse. It seems like people have arrived at the conclusion, oh, well, life is difficult, life is hard, money's tight. I will never be able to be where I want to be financially, so why would I even do anything differently today? I'm just going to keep moving in this direction. And I think that's just bad information. It's bad intel for a lot of people. I don't think a lot of people, when they come out of high school, out of college, understand the fundamentals of wealth building and budgeting and cash flow management and living on less than you make. I think we're failing our young people and having them prepared to be able to do that.
Do you think that that's on purpose? Because if you ask any intelligent person that has any ounce of financial literacy, they would argue it is clear-cut, objective, beneficial to everybody if we have more financial literacy in schools, if people know that they maybe shouldn't be taking out all of this ludicrous student debt for a degree that's not going to guarantee them a job. You're setting these kids up for failure. Is there a malicious reason maybe behind that? Are like the credit bureaus lobbying the universities saying like, hey, we don't want to promote financial literacy? Is there anything going on that we may be unaware of?
Well, I think that it is more lucrative for people to be bad with money. It's why payday lenders do so well. It's why credit card companies make so money. If you look at tuition, how much the cost of education has gone up, it's sort of asinine at this point. And there's sort of two sides of this coin. The more fiscally responsible individuals are en masse, the less profitable some of those entities will be. So there is a misalignment of goals. It's in the credit card companies or whoever's best interest for people to not make good decisions.
I think it's interesting because you were giving us a lot of stats. The one that always shocks me is if you look at the Fed data, the Federal Reserve data on net worths of Americans. You know where there was a huge pop in the last few years, and it was all homeowner equity, which shows me is that the only net worth that the typical American has is the equity in their house, meaning they're not saving any money outside of just the old American dream of just go out and buy a house and then, and you'll build wealth through that. That shows me that we are failing in the fact that there is a better way to do money. And if you knew, like one of the things, we just introduced a brand new resource we updated, we spent a lot of time kind of putting it out there, trying to make sure the education impact was there, is how much should you save? And it's if you go look at this resource at moneyguy.com/resources, if you just start saving anything when you're like 20 years old,
it's hard to screw
22,
it up.
I mean, it literally, you just have to basically do rounding errors and it can be small decisions like coffee, or it doesn't take hardly anything at all. That's why, look, take the politics out of it. But I do think there's an interesting experiment going on with Michael Dell's contribution and then these Trump accounts is what they're known, is what if we gave all newborns $1,000? Because we've done the research. If you go to the website, moneyguy.com/resources, you can be a millionaire incredibly easily. Now, look, I know we have inflation and other things, but I can tell you, if you want to get to $1 million or $5 million, get to the million first, and it gets much, much easier. Because I think if people knew that for your newborn, you only need to save $13 a month to be a millionaire, by the time you get to retirement. That's how powerful. But I don't think anybody does that. I mean, I think about, the typical age when people start saving and investing is 30 years of age, where they even discover probably your content, our content. I would love for it. Jack, I think it would be, and more high schools are adding curriculum. What I'm curious about is who's driving that curriculum. If you have the banks drive it, are they going to talk about credit cards, honestly? That's the thing that I always, because consumption is profitable. Selling you stuff is profitable. It's creating people who are independent and know how money works, it's not as easy.
I agree. And I guess for me, that just makes me suspicious because, like I said, every single person with above average IQ and some form of financial literacy would argue everyone needs to learn these things.
Absolutely.
It's not like if they learn these things. Hopefully it's not when they learn these. Like, we want it to be ASAP. People need to know this stuff way more than need to learn all of the other stuff that they're taught in the universities, especially with like the random prerequisites and these other classes that you're forced to take a language class before you learn financial literacy is absolutely absurd.
Do you think it would move the needle a ton, though? Because you've heard of the marshmallow test and other things. There is I've often wondered if we stratified. I wish there was more behavioral science research on just, is there always just going to be a portion of population? Because I think anybody can be wealthy. I really do. I truly believe it. But it's going to require discipline. You living on less than you make. You using that margin to actually create the money that then gets invested. And anybody, if you give it enough time, can be a millionaire.
You know what? It's the same thing with getting in shape. Like, everyone knows objectively how to be in shape, but there's only a small percent of the people who are actually in shape.
And we all know, hey, I need to eat good food, move my body. Eat good food, move my body. We objectively have that knowledge, and yet a lot of people don't carry it out. Saving money and building wealth is no different.
But this is why I love what we get to do. I mean, I really do feel like we're moving the needle. I truly do. If you go, now look, that's what we had a whole off-camera conversation. We just don't have the sizzle sexy of like setting cars on fire or doing weird things that people, but if you really want to know how money works, we try to lay it out there, so that people can learn the basics.
Yeah, I think that's what makes the Trump account so interesting, is because what Dave Ramsey would argue is that people might have the information, which I would also argue that most people don't have the information, but of the people that do have the information and still decide to not act on that information, it's because they lack faith that if you put the good ingredients in, that the recipe will turn out as you wanted it to. People think like, hey, if I go to the gym and start eating healthy, like I won't actually look the way that my idealized body looks. The same thing goes for investing. If I actually save money and I invest it, billionaires or a millionaire is so far out of reach. I'll never be able to get there, which is why I think the Trump account is so interesting, because it's forcing these people to actually see the light at the end of the tunnel because they can watch this growth over a period of time.
You know what's funny? It's not forcing people. I've spoken with several people who have just had kids in the last year, had no idea that the Trump account even existed.
Oh, see, that's a lack of
and
knowledge.
they're just like, what was that? And I explain it.
I got to do that.
I never heard of that.
Had they known, though, they would have signed up.
Maybe I'm just in a bubble. I'm like, how on earth do you not know about the Trump account? I don't know.
It's one of those things. We'll have young people all the time, high school students, college students. Hey, I just got, whatever. I just got my first paycheck. I have enough. I can go max out my Roth IRA. Should I go max out my Roth IRA? And this will surprise you. You know what my answer is?
Yes.
No. And here's why. So many times through life, I've told someone, hey, go max it out. Way back in the day, hey, put 5,000 in, put 6,000 in. They would do that. And inevitably, 2008 would happen, 2011, flat year, 2022, fill in the blank, and they'd make a contribution in March of one year.
One contribution.
One contribution in March of the next year, it's down. And they're like, oh, this investing thing is ridiculous. I don't like this. I'd say, hey, instead of going to max it out, just start doing $20 a month. Put $20 a month every month into your Roth and watch what happens. If you can get someone experientially to see what money can do, I'm doing this with my oldest daughter right now, and I'm showing her how interest works inside a bank account. And they can see, holy cow, no, I put $20 in there last month, and this month I have $20.50. Holy cow. And you can get them to experience it. I think that's where it starts to actually stick. It's just most people don't take that very first step of doing it. And then even with the Trump accounts, it's great to use that to teach someone. But how often have you seen someone who they go work for an employer has a match. They say, okay, if you put in 3%, we'll put in 3%. And they do that, but that's all they do. And that's noble and that's great. But if you don't actually increase that, if you don't get better at it, right, it's not going to actually move the needle. So you have to start somewhere, but then you do have to improve through time.
So what's interesting, though, is that just as many people are living paycheck to paycheck, making over 150 grand a year, as making under 60,000.
It's a behavioral issue.
It's not about the dollar. It's not about the dollar figure.
There's a lot of wealthy or rich in income, but still dirt poor people because they spend every dollar they make.
But what separates the people who make less but still are able to get ahead?
It's the discipline. It's the teachers. That's why teachers are always so successful. They somehow
is it a knowledge problem though? Because I would argue that just as many people have the knowledge to be able to get out of that.
Well, and I think a lot of people, even when they're able to get to high income, $150,000, $200,000, $300,000 incomes, you would not argue that they aren't intelligent, don't have knowledge. They must have some level of knowledge to get them to where that they are. But discipline really is, we talk about the three ingredients. There's discipline, there's margin, there's time. You have to have all three. Discipline is the one that matters the most in every facet. Like whether you're a 20-year-old or you're a 60-year-old, if you don't have discipline, it's going to be very, very hard for you to be successful financially. That's why we see so many professional athletes who sign these huge contracts, have these huge salaries, and end up broke. It's a discipline issue.
If you look at the categories that typically become millionaires, historically it's like your teachers, your engineers, and then like your accountants are those very popular categories. There's a big disparity on income between those, but you know what they all have in common is that they all start jobs pretty early in apprenticeship type things, early 20s. They kind of all encourage systematic type mind and thought processes. It's the starting early and often that kind of does it. I mean, and I know it's not sexy enough for people to say this cannot be what it is. And I'm here to tell you, just do something. I mean, because that's what got me. I mean, it's back to my Morrow moment, that high school teacher who told everybody in the class, look, if you could save $100 a month, you'd be a millionaire. And coming from no money, I was like, I could be a millionaire, $100 a month. I was working fast food. I was like, you mean I could save $100? I really did think that. And that's what made it happen for me. And it's the reality. It's the truth.
Okay, so this as a challenge, guys. Not that we are, financial advisors or anything. If you've never invested, open up an account. What brokerage?
I mean, any of the big ones, that like the low-cost ones, like you think with Charles Schwab, Fidelity, Vanguard, and then just buy the market, the index. Buy like a total market index, S&P 500.
Contribute some amount of money into it.
Or a target index fund.
And send a screenshot of it to the email that is right on the bottom of the screen, and we will respond to it, just saying, good job.
What about Robinhood?
Robinhood's a great one too. One of my I don't want to say problem. That sounds too aggressive, but Robinhood has gamified a lot of stuff that allows you to get distracted. Like when I go into Robinhood, now I can start doing sports betting and all these other things. What I don't want someone to do is be, I'm going to start investing. And they see this shiny thing in the corner and they're like, oh, okay, well, now I'm going to go start picking stocks, or I'm going to go start doing sports betting. Or I'm going to go start. I think some of the larger brokerages have done a good job of not letting that become so flashy and so in your face. If for a disciplined person, I don't think Robinhood's a bad solution necessarily, but I would probably go with one of the big low-cost anchor providers.
In the beginning, your savings rate is so much more powerful than even what you invest in. So that's why if you can that's why I like broad indexes, because it lets you just set the behavior, let it take hold, let it grow roots, let the compounding growth actually do something. Because you said, I can't remember which one of you said it, said people never can imagine a small thing can turn into $1 million. That's because we think in a very lateral, linear way instead of thinking in the exponential way that money really works. And that's why I don't like the gamification to where people get distracted, because that's where young people, a lot of times, they're trying to cut the corner off. I mean, we've had young people show us that you can play arbitrage with sports betting and all these other things. They're fun distractions to kind of look at, but they're not actually what I would consider what I'm going to be able to set my retirement by. That's why, like when I was writing in Millionaire Mission, I said, fish with nets because you want to feed the family. Go sports fish, for fun later. But if you're going to actually try to feed the family down the road, fish with nets, which is what index funds do.
And really quick, I shouldn't have to say this, but we all think it. Life could sometimes be extremely busy, and eating healthy can oftentimes feel like an impossible task. With work, friends, family, and everything else you've got going on, nutrition can often take a backseat. But that doesn't mean it's not important. Prioritizing protein, minerals, and fiber could really make all the difference.
And that's why we are so excited to be partnering with Huel. Huel completely eliminates the hassle of cooking without sacrificing your health or your bank account.
For those unaware, Huel is complete, balanced nutrition in 2 forms. The ready-to-drink is a full meal that you could grab and go, and the Black Edition powder gives you the quick option that you could make at home without the hassle of cooking.
The ready-to-go drink is the most convenient option. It's a complete meal with 35 grams of protein, 7 grams of fiber, and 27 essential vitamins and minerals. It's gluten-free, contains no artificial sweeteners, colors, or flavors, and requires 0 prep while still being very filling.
It's also under $5 a meal, which makes it a practical alternative to many quick breakfast or lunch options.
The Black Edition powder works incredible for just days at home or when you want something that's more customizable. It has 40 grams of protein per serving, mixes super easily, and can be blended with ingredients like fruit or milk, literally anything you want, just depending on your preference.
Having both options helps keep routines consistent. Powder for more flexible or customized meals, and they're ready to drink for busier days.
Seriously, guys, I could not recommend it more. It is the easiest way to stay on track of things like daily protein, fiber, and just overall nutrition nutrition without needing to break the bank or plan out every single meal. It is so convenient, so delicious. I could not recommend it more.
And for a limited time, you could get Huel today with our exclusive offer of 15% off online with our code ICED15 when you go to Huel.com/ICED15 with the link also down below in the description. It's for new customers only. Thank you again to Huel for partnering and supporting our show. And now let's get back to the episode.
So to settle the debate of this harsh truth about money, would you then say if someone is not where they want to be financially, if they're broke between the ages of, let's just say 25 and 45, is that their own fault or the fault of the environment around them?
I think certainly some people are born into more difficult environments to come out of than others. I don't want to minimize that idea, but I do think that building wealth is available and attainable to all folks, no matter what your path is, no matter where your financial journey, no matter how bad it was at the start. That does not define what the end of your financial journey might look like. So you might have had different circumstances that caused it to be more difficult for you, but I still think even for that person, they have the ability, whether it was environmental and circumstantial, or it was their behavior. I used to run up credit card debt and live on more than I make and, make all these bad decisions. I do think that there is an onus where they can change that, where they can actually improve their financial life.
It's a mindset issue. If you look, we all hate villains. But I'll tell you, villains and, unfortunately, victims don't come out ahead. So if you self-define yourself as a victim that this system's built against you, you'll never get yourself out. Whereas if you can put the mindset that, the system's hard, but I believe, and these guys are sharing some of the tools and taking an active role to be the hero of your own story, I really do believe anybody can do it. And it's a mindset thing. Because we've done shows. We got a show that I'm so excited it's coming out where we said, is it truly harder for the new generation versus the baby boomers to get ahead? And we found out, there are some things that, holy cow, we ought to be pretty ticked off about what's happened in education and even some of the things somewhat in housing. It's not as bad as what happened in education, but still, there's so many new things with technology. I mean, if you saw what it was like to try to invest when I came out of college, you had to go through a broker. You couldn't buy index funds. It was just completely a different game. So much has happened. Now you can go online. You can do everything. It's instantaneous. You can do something.
Do you think AI is going to make it easier, or do you think that's going to mislead a lot of people?
Yes.
I think it's both. I think Bo is exactly right, because we've even found, it's amplifying what we can do for clients. It's not taking us out. It's going to make us better. But I do think if you're a person, and this is something I've tried to figure out. I'm not trying to change the subject to AI, but I think people ask us all the time, like, how, when you're trying to do Roth conversion strategies, how long does that take you to figure that out? And I'm like, well, I can typically in 45 minutes of looking at your portfolio, I can have a pretty good plan, but it took me 15 to 20 years to kind of really know all the things that go into all the factors and all the variables. So, it's 45 minutes, but there's 15 years of experience or 30 years of experience now where I'm at.
15 years and 45 minutes.
I think AI is going to bridge a lot of that stuff, but there's still a lot of ghost in the answers, meaning the information. We've even been playing with some LLMs, and there's so much confidence in bad answers that if you don't have the experience to actually see what the output was to kind of navigate, I do hope younger people don't lose the ability to be able to see how to think through things, because we outsource intelligence only to the AI models, because I think that's going to be scary for our kids and the younger generations.
So I think that technology and artificial intelligence will make it, yes, perhaps easier to invest, easier to build a portfolio, easier to gather information. But I do think it's also going to create the opportunity to be distracted, as most other technologies have done. So there'll be pros and cons to it. It'll be interesting to see how it shakes out.
Haven't y'all noticed that when you talk to any of the chats, or ChatGPT, the Groks, they're all just trying to make you happy. So they have this level of confidence. Yeah, but they are trying to.
Grok
people pleasers
has been really good.
Yeah,
ChatGPT is awful.
To the point where in terms of just a confirmation bias, wanting to say what you want to hear.
Yeah, Grok I found to be pretty objective, but ChatGPT yesterday, I was trying to figure out at what point the S&P 500 would have to fall for me to get a capital call on a box spread.
Okay.
And it was so confident. It was like 72%. I'm like, that's incorrect.
Did you check the math on it?
Yeah, I did.
Okay.
I knew that was incorrect.
Yeah.
And I said, oh, sorry. Actually, it's 68.
Yeah.
I said, no, that's not correct. Oh, it's 84. I just kept changing it.
It's just
and then I
random.
said, no, it's 90% plus. He was like, oh, yes. My apologies. I was interpreting incorrectly how you phrased the question. It's actually like 94%. Like, that's too high. Oh, actually, it's
and it would keep saying, "Oh, you're right. Oh, great catch. Oh, I'm glad." And I'm like, "No, I'm not supposed to. You're supposed to catch it." It's frustrating.
That's why you do have to be careful, because the confidence that it comes out of the gate with is really strong, and there's a lot of ghost in those numbers still.
But what's interesting is that now brokers are implementing this new AI into their system where you could tell it what you want it to do, and it'll execute whatever trade on your behalf. So if Jack wants to buy call options on Amazon at a certain strike price, he could literally just type it in the chat, and it'll go and do the thing that he's described.
Which brokerages have that?
Public and Robinhood are launching that. Yeah.
Interesting.
Yeah.
But I do think one of the things. So when I hear you say that, I was like, "Oh, that's really neat. That's super interesting." At some point, Jack would have to decide, okay, should I be buying call options on Amazon? You know what I mean? Just because you can doesn't mean you should when it comes to that financial stuff. So that's like a really neat thing. That's probably like a cool value add, assuming it makes sense for me doing that. What I wouldn't want someone to do is hear that and be like, "Oh, I'm going to go get that, and I'm going to start buying call options." If you don't understand what that is or how that works, that might not be the thing.
It's going to talk to you like ChatGPT. Great call. I totally agree with this.
Do you think Apple's alive right now? Yes.
You're the next Warren Buffett.
Graham said that he thinks selling covered calls is the dumbest thing ever. What are your words on this?
I said it was pretty dumb.
He said selling covered calls is pretty dumb. Can we just?
That's a broad statement. I mean, how far out of the money? I mean, what are you? There's so many. What stock? I mean, there's so many variables here.
Like very little out of the money, but within like a month, 2 months, give or take. You know,
how is that dumb?
Because you're picking up pennies at the expense of the long-term stock market growing, and there's no such thing as free money.
That was my question.
Yeah.
Whenever someone asks us, "Well, what do you think about this?" I always default back to why. Okay, selling covered calls. Why do you want to sell covered calls?
I would say there are certain stocks that I'm like hesitant on buying. For example, let's just say Chris Camillo says you should buy Bloom Energy.
Okay.
I'm like, well, I don't necessarily want to do all of the due diligence into why I should buy Bloom Energy, but maybe I would like to have the appreciation of this Bloom Energy. And so I go and I buy 100 shares of Bloom Energy, but the only way I justify myself to buy this 100 shares is because, let's say, I can get 3.5% per week on weekly call options if I want to sell covered calls. That's a good enough hedge where, hey, look, if it does end up going down, do I think it's going to go down on average more than 3.5%? It could. Could have gone less than 3.5%? It could, but still I have some appreciation of a stock that he told me I should buy. I get to watch it. I get to be more like involved with the...
Okay, so let's play the other side of it. You do it. You buy the Bloom Energy and you're selling this. And then Bloom does some exciting stuff. And it takes off.
And it did.
And it just...
It's $300 now.
And your position, it gets called away.
Would you buy it?
Well, I bought it kind of all over the place, but let's just say like my average. I don't know why he's laughing because I made more money on Bloom Energy than him. So go ahead and keep laughing, buddy.
But let's say that it gets called away.
Yeah,
right.
It did.
Forever, you're going to be sitting in that position where you're like, man,
y'all are just like we are. That's hilarious. Y'all totally pick on each other.
It's insane that he's laughing because I made more on Bloom Energy than you make on Bloom Energy. Dude, I'm up like 26 grand right now on my 200 shares I'm holding.
I'm up more than that.
Oh yeah, you're up like 60 grand.
But y'all are making my point from something I said earlier. Do you want a sports fish or are you trying to feed the family? Because y'all are
I'm up way more than that.
Y'all are no different than two buddies who go out fishing so you can tell fishing stories on the fish that you almost caught and it got away. Whereas I'm telling you, there's a huge difference between investing versus speculating. Some of this stuff, this is speculative.
It's hardly. I mean, sure, because you're trying to, but you're making money off of time, which is what you're doing with invest.
But
you're not. Explain that. Explain theta decay, please. Explain that.
Jack doesn't understand that when he buys a stock, there is a risk that it goes down. Mm-hmm. So if he's making 3% in a week, it could very well go down 6% in a week, and he's net negative.
I don't understand
when accounting.
I absolutely do. Your position is more bullish than my position because mine is actually a hedge against the position.
And that's why I'm up so much.
But you were speculating more than I was.
No.
Yes, you were.
I bought in cheaper.
So one of the questions I'd be asking is like, okay, what's the thing?
I'll show you my.
What's the thing you're trying to accomplish here? What's the goal you're trying to achieve? What do you want your money to be doing for you? In the instance that you're describing, that would not be one that screams to me, "Ooh, selling covered calls makes a lot of sense." Where a covered call position might make sense is if you're executive who has a highly concentrated stock position. And you want to figure out a way, okay, I can't sell this position because of embedded gains. Perhaps I'm going to do some sort of strategy where I want to protect my downside, but I also want to recoup some premium on the upside to cover the cost of the put. Something like that. in your scenario, if I was trying to just make a little bit more money on it and I was, bullish on it, I would maybe just buy a different stock that would do something differently. Because I agree with you, just because you can make some money doing something, oftentimes doesn't mean it makes a lot of sense. You can go walk around the freeway and pick up cans, and you can bag up all those cans. You can spend a couple hours doing that. You can take them in and trade them in and get the recycling money for that. But is that a good use of the time, and was that a good use of mental calories?
I don't think it's all worth the hassle factor, because look, I've had this has happened to me so many times in my decades of investing. Like, I'll meet a neighbor and they'll find out he's over here calculating returns. I've had a neighbor find out I'm a financial advisor, and they're like, what stock do you recommend? And then they're talking to me whether at the time it's Fitbit or whatever the latest greatest thing is. And then what's always funny is I tell them, once they get to know me, I'm like, I buy index funds. I mean, that's what I actually do with my money, is I buy index funds. And what's funny is I watch the education is after we get to be friends and 5 years in the future, and they go, I started looking at my annual return of all the trading I was doing in individual stocks. And then I started looking at what I was making on just the total market return or the total market or the S&P 500 index. And I think I'm making more money on the S&P 500 or whatever. And I'm like, yeah, it's amazing. And you didn't have to stress out and think about everything that was going on. That's the reality I try to share with people. Because even if let me play devil's advocate. Because even if you weren't selling the covered call where you got it taken away from you, if it shoots up, I've experienced, because I even have a story back in 2008, I called all my buddies and I was like, look, Apple stock right now is trading at a price that is the equivalent of what their physical assets. I'm not talking about the actual IP and intellectual property. I'm talking about the campus and other things. Wow. This stock has been beat up so bad. I was like, this is the biggest no-brainer. We should buy some Apple stock. So me and some buddies, because I don't buy a lot of individual stocks. I'm an index investor. We bought Apple stock. And let me ask you, this stock you bought, would you have sold it if it was up 200, 300, 400%? Or would you have taken your money?
Probably not.
You would have kept it? You would have just rolled forever?
I honestly
ride or die.
Have never really sold stocks. The only thing I've ever sold really.
So you have permanent portfolio on everything?
Except for Robinhood.
Dogecoin.
Except for Robinhood,
because that was a different thing.
You're the type, Jack, you're the prospect that we would get. I want to get back. Don't let me get off topic on
Margin called $10 a share for Robinhood.
Yeah.
Wow.
Jack, it would be the prospect that comes to us, and it looks like a quilt of his life. It's the quilt of Jack's wonderful life, because you can see what he was doing in every decade of his life.
3.5%.
3.5%. Guess what time?
How long?
This is 1 week. If you sell a call 25 cents out of the money on Robinhood, weekly calls, you can get 3.5%. This is just linear growth, not even counting compound interest.
What price
times 52. This is 185% return on Robinhood over the course of a year.
What price did your balloon get called away at?
It got called away at a few different prices. I mean, just like I had quite a few different
So that's why
it was like 88, 92, 94. I was making money on all of it.
What's it trading for now?
$280.
I would argue that the long position you missed out on did not compensate for the ROI you got in the covered calls, right? Like, had you held it,
but I'm not observing. I'm just observing it in terms of what is the growth expressed as a percentage.
Sure.
And so and also I had 200 shares because guess what? It started going up and I had 200 shares that didn't get called away from me. I'm like, I'm just going to ride it out. And I did. And now it's at 200 and whatever dollars. No. And so I'm just saying, a company as solvent as Robinhood, do you think that it's going to zero in the next year?
I haven't looked at their financials. I wouldn't.
Probably not.
I wouldn't.
Probably not. I met Vlad Tenev. We had him on the podcast, the CEO, founder of the company. Mm-hmm. Everything seems totally great. Love the company. Have used the app. Like I invest on the app. It's phenomenal. And so why, if the company doesn't go to zero, assuming that premiums stay the same, right? You'll get 185% return in a year.
But is this the best use of your time? This is the point.
For me, is it the best use of his time to be hunting for a coffee that's $1 cheaper? Right?
It's the hunt.
Right. Is it the best use of your time to buy 5 of those shirts because they give you at checkout an additional 5% off when you add other things. But we were talking about that before the episode.
Let me bring it back to why I don't love individual stocks.
Now, I gotta say, one thing that I've noticed by talking to a lot of entrepreneurs is that all of them want to use AI, but they don't know how it'll actually work inside their business. Like, it's one thing to use AI to write an email, but it's another to have it handle incoming calls, set appointments, answer questions, and talk to customers in real time.
And that's where today's sponsor, 11 Agents by 11 Labs, comes in. It's a platform that lets businesses build real-time AI voice agents for sales, support, operations, inbound calls, and more.
What's really impressive is just how fast it is to set up. You could launch voice agents in minutes, and they could speak in over 70 languages. Here's an example.
¿Podrías decirme qué tipo de ayuda necesitas?
It also works with tools businesses already use like Salesforce, HubSpot, Zendesk, Google Calendar, and Twilio. So instead of having to change up your entire workflow, it fits right into the systems that you already have.
And you could train these agents using your own knowledge base, SOPs, and policies. That way, the responses seem consistent within your business instead of just sounding generic.
Plus, with expressive mode, they give you way more control over the tone and delivery, so the conversations sound way more natural and human.
So try out 11 Agents by going to 11labs.io/icedcoffeehour to get started today for free. Again, that link is down below in the description. Thank you so much. Now let's get back to the episode.
Let me bring it back to why I don't love individual stocks. Because I just gave you the perfect example of Apple. We got in 2008, dirt cheap. Me and buddies all threw a few $1,000s at it. When it went up threefold, I jumped out because I was excited. I made 300% in a short period of time because when the market recovered, it came back quick because everybody else caught on that, hey, Apple's a pretty good company to own. My other buddy, I think he might have held on for 4 times. But the thing is, we all dropped off. One of my buddies, he still owns it.
You never got out.
So I know he might be the jack.
So what is
you know,
he?
we all
Does he
might
have
need a jack
couple
in our
million
friend group.
bucks?
It's worth I think he put in $5,000. It's worth over $500,000 from that one holding.
Wow.
So I mean that, but I'm telling you that that sounds great, but the majority of us
Are
would
gonna exit
sell.
before that.
You would sell.
This is not anything that I would recommend publicly because
Sure.
it's like you need to. This is purely logic, no emotions whatsoever.
What Jack is trying to say is that he's able to make over
Trying
100% a year with little downside if he keeps doing covered calls, right? Because if he gets the shares called away, he could always buy a little more
I'll
and
just
make
buy
another
100 more
3%.
shares.
But the
and then
problem
make
is,
another 3%.
there is some long term because you're getting called away on its short term holdings, so you're paying.
So yeah,
you're paying
paying
ordinary
tax,
income tax
short-term
rates
capital
instead
gains,
of the
yeah.
long
That's
term
why you do it
capital
in a Roth
gains.
IRA.
I mean,
But okay, when you buy a position that actually does go down, that doesn't come back, and you made a poor purchase, you can't get those dollars back into the Roth. My opinion is if you're going to do those sort of strategies, I think the losses would likely be more valuable than sacrificing Roth dollars you will not be able to replace. Roth, you only get $7,500 in there at a time. You make one bad call that loses you 20, 30, 40 grand. That's like years and years and years of contributions you won't get back unless you have another, investment that hits. I would argue the tax drag is something I'd factor into my calculation, and I would consider it my tax.
So even QQQ, right? For example, you can sell daily call options on QQQ, and if you extrapolate that over the course of a year, it's like a 26% guaranteed return. If you were holding QQQ in your Roth IRA, why would you not guarantee a 26% return as opposed to what else? What other way you could get
if
that?
It were a guaranteed 26% rate of return that was an assured thing. Why wouldn't every fund manager in the world be doing that? Why
It's
wouldn't
probably
every
a volume
investor,
thing.
right?
Well,
Because
they do covered call ETFs.
they certainly do, but not ones that are guaranteeing 26% rate of return. Because once an inefficiency exists, we operate in a capital market that adjusts pretty quickly. So yeah, inefficiencies can exist, but once inefficiencies get exploited, they then become efficient. So I'd argue, I don't think something like that has staying power, where even if you made 3.5% for a week, and if you did that for multiple weeks, I don't believe that would sustain throughout the course of a year. So I think it's illogical and irrational to assume that you could extrapolate 185% rate of return. No different than look, it's not the exact same thing, but if you go to a casino and all right, I hit red, I hit red, I hit red. Well, if I did it 100 times, think about how much money I'd make. That's not the way that it works.
I mean, you can get 0.3% daily on QQQ calls at the money, which is not too bad.
but you do realize, like you said, you make 185% or
Yeah, on Robinhood selling covered calls.
Bo's exactly right. If you could actually do that repeatable, in a guaranteed way, people would be making you'd be able to do that. And there are structures. Carter brings to us all the time these crazy structures with, that you can set. He's going to be mad that I said the word crazy, but he looks at those things where they do try to play these crazy arbitrage situations, and they're interesting, but it's not something. I don't know. Maybe this is where I'm too boring.
The reason why billionaires don't do it is just because it's a strictly like volume problem. There's not enough volume.
But why not millionaires? I agree with you.
A lot of millionaires do. Yeah, I mean, a lot of people retire just doing the wheel strategy.
What's the wheel strategy?
You sell a put, and then if you get a stock put to you, then you sell a call to get it called away from you.
I've never heard of that.
I would ask you to track your time on all these things too, because I think if you add the time element to all these hobbies,
it seems like it's a hobby. This is something you enjoy. You're not doing it so much for the economic outcome. You're doing it for the enjoyment.
Because this is the same problem I have when people try to compare my index investing to like real estate investing. I'm like, yes, levered debt is going to do incredibly well compared to an index fund, but let's put into how much time you have to put into the real estate and everything. The time that's going on these strategies is worth something too.
Yeah, I sell calls on maybe 5% of my portfolio, 10% of my portfolio, transparently.
So this is just play money.
And yes, I have lost out on a lot of gains when stocks have gone up, but I've also decreased my level of loss when stocks have gone down. And if you extrapolate this as a return, or maybe expressed on an annual basis, I beat the market like consistently since I've done.
Not counting Bloom.
I'm good.
Yes, counting Bloom. I made money on Bloom. I don't understand.
Not the shares that got called away, though.
I did make money on the shares that got called away.
3%.
Yes, in a week. How was that bad? 3% in a week is 150%.
They're up to 100% since then.
But I'm talking compared to like the average stock market returns.
Here's what I can't wait to see, Jack, because y'all have already put yourself in a box because you said you're going to let us see your portfolio at the end of the show today. So we're going to get to look at your portfolio. You've also, because we've all gotten friendly, I kind of know what you make to a degree. We're going to judge you hard if we know how well you're doing in life, and when we look at your portfolio, we're expecting to see magical stuff. Because otherwise,
why don't we do that right now?
Because otherwise, I want to feel like you're
here right now.
You're growing with you have so much capacity to grow with your good income.
So the money guys react to my stock investing portfolio.
All right, let's go.
Okay, let's look at this. Now, can I ask you a question though?
Yeah.
You shared last time we got to hang out. I kind of know what your income is.
Okay, so this account.
The multiple. How long have you had that income that you shared with us last time we got to hang out?
What did I say my income was?
Well, I can't. I'm not going to say that. I'm not going to say that. I'm not going to say that.
Maybe
here. You want me to write something?
Maybe a year and a half.
Okay.
Yeah.
Okay. Because I want to see a multiple of that.
I invest.
You understand?
I don't spend any money.
So
I mean, you could look. This is like my gains over time. See, I don't spend any of my money. Most of my money is in this, or not that, but like the Vanguard equivalent.
And Jack, let me ask you another question.
Yeah.
When these stocks on volatile days, like right here, I mean, if there was a stock, none of them are having huge days.
Yeah.
But if you lost 20, 30% in about a 3-day cycle, do you emotionally feel like you get, does it feel like you got kicked in the stomach? Do you actually have emotional reactions to what's going on in your portfolio?
No.
So as I'm looking at this, right, like I'm just looking at this is specifically your taxable account. So you were kind enough to let us look through all the accounts. I was expecting to see a bunch of really, really crazy stuff in here.
It's actually a bunch of household names.
The lion's share of what you have is
even SPY.
Yeah, or in like, low cost ETF indices, which I think is fantastic.
This is like QQQ.
Vanguard.
Yeah,
which
right.
I have
It's
the
vast majority. And so
you're dabbling.
So like, you have
dabbling.
You have some individual stock positions, but at least in this account, I'm going to say relative to your total wealth, relatively immaterial. So this doesn't give me a lot of pause. Like I'm not super concerned in this account. And these names that you hold aren't really frightening names. They aren't things that I think I would be afraid of holding. I do see some losses in here that perhaps if I were worried about my tax bill and stuff, I think maybe clip that loss and find something that seems a little bit more attractive. I know he really likes that one though. So
which one is it?
You could say the names of the stocks, just not the amounts.
Okay. Robinhood, that's one that you really super bullish on. Your position right now though, pretty attractive loss in there that could be used to offset some of these future capital gains.
You can say how much I've lost.
It's 20%. It's 20. You're down 22.5% on that position. Might be a great little loss to clip, just so that way. In our world, losses are great. We don't love losing money, but whenever losses are present, we love taking advantage of those. Mm-hmm. So that's something there.
Can I look at something?
Yeah, I want to go. I want to get to the Roth because that's the one I think is going to be.
I'm just going to say this. I would say I couldn't do the math because it was moving really quick before me, but it looked like 3/4 of that account that we just looked at was pretty much in what I'd call tried and true,
it's
index
QQQ
fund type
though.
fund or stocks that are in the index or the top performers. So, in the top,
it's tech heavy.
It's super tech heavy.
It's already, because the S&P 500 is already probably highly concentrated in a lot of these stocks that you already have. I don't think you're acting like you're an exotic, and it's actually pretty plain vanilla.
Yeah.
In a lot of ways, if you look at the 75% of this, 80% of this is doing the same thing. So then I'm back to my point of what are we doing here? I mean, it's the hassle. And I'm fine with that.
I actually have made money on it.
Well,
a decent amount of money.
A lot of people, there's a number of people that made money gambling. There's a number of people that make money in sports betting. There's a number of people that do those things. You can make money on hobbies. I'm not disagreeing with you there. But what I'm suggesting is it's more of you get utility out of this. Totally fine. I was nervous I was going to look on here and see a bunch of like penny stocks that you had $100,000 in.
It's much more.
I wouldn't do this strategy on a stock that I'm not bullish on.
What would you rate his portfolio out of 10?
From aggressiveness or for quality of portfolio?
Just overall for his age.
Let's say, quality of portfolio considering my age, my income, the industry I work in, et cetera.
How much time are you spending on this? I know I keep asking that.
Honestly, none.
No, but you are spending time because you obviously you've got stuff all over the place.
I can show you my Schwab screen time. I mean, maybe it's 5 minutes a week, 10 minutes a week.
Okay.
I literally I don't even look at the numbers. I just hop on and I just I sell a call if I need to. I'll buy something if I have some spare cash.
I'm gonna give you a 7.5, 8. 7.5, 8. And I'm also want to disclose this portfolio is probably going to perform pretty well because it's very aggressive, right? So we see a year like last year, 2025, where the market did really, really well. I'm willing to bet this portfolio did really, really well in that kind of year.
Now, the things I'll pick on is also, I do see an individual 401k, but there's no money in that account. There is a SEP IRA where there's some money in. You strike me as with your level of income, that solo 401k should have been fully loaded.
It will be, yeah.
Okay.
And that's why, that SEP IRA will probably disappear, right? Yeah. So then we're going to open up some opportunities, do some backdoor Roth contributions, that sort of thing. Because, and look, you've been saving good. This is a big.
Yeah, because that's the other thing.
It's a big. How old are you again?
27.
27. That's a really, really solid.
No,
number
you're doing great in the fact of where your age and where the assets are at. And your Roth, you probably haven't been able to make contributions because of that SEP.
Yeah.
So, but we're about to change that by doing the solo 401k. Yeah, so there's some account structure stuff that I would totally want to clean up so you could do backdoor Roth contributions and then really give it to the man legally by loading up that solo 401k. Maybe y'all have enough profitability. They could potentially do like cash balance and other things too.
Graham would attest that I have never been a big spender. I have never spent money on anything. The most expensive thing I've ever bought was my car, aside from my house. And I bought a watch.
Very nice car?
It was a Tesla.
Oh, okay, yeah. But it's not, you didn't go out and buy a Cullinan. You bought a reasonably nice car.
Yeah.
What has he got?
Look at his unrealized gain loss. I'm assuming, is that, okay, now I want to see realized gain loss year to date. That's going to be on here, right? Yeah, that's just interest and dividends.
Oh, it doesn't show losses and gains.
Because what I was trying to see is how was it tax inefficient? So one of the things that
it was probably tax inefficient.
Yeah, a lot of people, they like trade and it gets super exciting, and then it gets to April. And if they have an accountant, they got to pay their accountant an extra X number of $100,000 because of the 4,000 transactions they have to put in, or at least 4,000 transactions they have to monitor when they file their tax return. And then there's usually a huge capital gain that thought, if they've had success and they've not been harvesting the losses. So I was trying to see where that existed. But in full disclosure, I'm going to give you an 8 out of 10. 8 out of 10.
What would take it to a 10?
Some
not
more
busy?
well thought out strategy, right? Explain to me how you defined your allocation. Because what I really see is it's a lot of U.S. Fortune 100, Fortune 500 tech companies, which is fine, but there's a lot of concentration in the singular asset class.
Okay.
Perhaps for a portfolio that size, I'd want to see something a little more diversified.
So my response to that is I think that the asset class that I'm in right now is tech is going to just grow faster. And for me, I'm very, very, since I've been investing for so long, I've weathered so many ups and downs. And I also assume every single time, because I don't dollar cost average, whenever I take a distribution from the company, let's just say I take $10,000, I immediately take $2,000, put it into my checking account, $8,000 immediately into the investment account.
How often do you take distributions?
maybe monthly, month and a half.
That's dollar cost
Yeah.
averaging. You said you don't dollar cost average, but that is in fact dollar cost averaging.
Okay,
if every
sure.
month you're doing that.
But
that's great.
I basically just buy as much as I can, and I buy as quickly as I can. And then if taxes come up and I need money for taxes, I'll even sell my investments in order to pay my taxes. Because here's the thing, though: if you extrapolate this over a long enough period of time, then it's a winning bet.
If the market went up that year.
But if it went up that year, it went down that year, but if on average the market goes up 10% per year, you're taking a 10% advantage bet. It's like you're being the house with a 10%
you said
advantage
you love,
every year.
You love
sequence of return does matter, though.
You love 3.5% guaranteed so much. If you just park some of that money for that tax bill in a 3.5% high yield account.
No, but he likes 3.5% a week.
It's in a week.
It's not,
Okay, fair enough.
Fair enough. In a week.
Not a year, man.
That's a strategy. That's a strategy.
I do think that there's room for improvement on structure, which you already know, though, because you just talked about that.
I think the structure is probably...
and you see, like last year, again, we are bullish on the same things that you were bullish on.
Yeah.
But we do still love like international holdings. We do still love small cap. And like if you look this year, especially the first quarter, when we saw volatility in the S&P 500, it was wonderful to have those parts and pieces in the portfolios because they've outperformed. They outperformed last year, outperformed this year. So again, it's an 8. I would just love to see more like thought behind it.
Mm-hmm.
It looks like the thought is, I like this today, I'm going to buy this today.
Yeah, and then just hold on to it forever.
And just hold on to it forever.
Mm-hmm.
Yeah.
So speaking of investments, though, the market has hit today officially an all-time high at the time we're filming this right now. Should investors be worried about this?
Do you know how, I figured y'all were going to ask something like this, and I should know the exact number, but I don't. You realize we've had I think it's 200 plus all-time highs this decade alone. In the 6 years. Yeah. So, when markets run through bull markets, so, you start going up, the market's up much longer. Like bear markets typically are 11 months, but bull markets run for much longer. So you hit all-time highs over and over again. So,
okay, but this chart is pretty scary. This is going viral right now on Twitter. And the caption is, only one question. Who's the exit liquidity? That's a spooky looking chart.
Yeah, it is a spooky looking chart, but 1984, right? So we're looking at 40 plus years of data right there.
That is the economy, though.
That's what's happened. Think about where U.S. GDP is today relative to where it was in 1984, right? It's a very different thing. The pizza pie gets bigger. Should you be concerned about the market hitting all-time highs? If you haven't thought about your asset allocation and having a portfolio that matches your risk tolerance, your risk capacity, and your unique financial needs, then yeah, you should be worried about that. But you should be worried about that before the market at all-time high. Warren Buffett, is famous for saying, be greedy when others are fearful, fearful when others are greedy. What you never see Warren doing is when markets hit all-time highs, he doesn't dump his portfolio. He doesn't sell his positions. He may store up additional cash when he thinks there aren't things that are attractive, but he's not being afraid. He's waiting for that moment where he actually can be greedy when the opportunity persists. So I think if you're in the right portfolio, well-structured, well thought out, right asset allocation, right asset location, if the market does go down from here 10, 20, 30, even in 2008, 37% over the course of a 12-month period, the right portfolio should be designed to weather that well for your unique circumstances.
Look, I get the fact that a lot of this is concentrated in some of the biggest AI companies and technology companies right now. What I'm trying to figure out, just being honest, because we don't, by the way, I'm going to be transparent and tell you, I don't have all the answers, but you should also know everybody who tells you they do with the confidence, they
Also
don't. I'm
the
fully in the system, and I can tell you they are probably trying to sell you something if they act like they have it all figured out. What I'm trying to figure out for myself is when you see this big run up, I'm old enough that I've been around for the personal computer coming on the scene. I've been around long enough when web, and the internet changed the world. And here we are in a new disruptive technology with AI coming on the scene. I'm trying to figure out, is this what everybody's worried about is a bubble, or are we truly at this, what Elon was alluding to, at this new disruptive side of things where efficiency and profitability gets expanded at a level we haven't seen. It's kind of like, the horse and carriage compared to what happened when you got transportation, and then take it up to another level when you got air transportation. We don't know yet. And that's the part. I trust the economics of an index fund more than I do a manager, that we'll see. And plus, we're diversifying. I will tell you, I just got off I had a client meeting right before this interview where the client, when I got in the meeting, I thought he was retiring in the next 2 to 3 years. So we planned on having a lot of heavy discussions on, let's start all-time highs right now. Let's start bringing down the risk profile slightly. We're not doing apple cart turnover, exactly what Bo said, but we're going to bring it down slightly. He let me know he plans on working for many more years, so we're going to let it keep rolling. But you should make sure your allocation is good so that before something big happens, you don't have to react. You're good before, during, and after. That's what diversification is supposed to do for you. I'm always amazed that people think that they're going to do, and that's why I always pick on the VU for life. I love the S&P, but there is too much of a good thing is if you think that you're going to do this until you're 55, 60 years old, and then you're going to slam your retirement into the ground and just, you'll be okay. That's scary to me. I mean, and I made the analogy of air transportation on purpose is because if you flew commercially and the pilot got you up and then threw you into the ground as fast as possible, you would never fly commercial because you'd have a phobia of it. But what you want to do is you want to glide path this thing down, live your best life, and not have to react no matter what the market. Because there's already going to be weird stuff that happens to you emotionally when you leave the workforce. So you might as well make sure that your money can actually keep you safe while you're kind of going through the ups and downs of the volatility.
Who do you think should manage their own portfolio?
This episode is in partnership with Airbnb. Graham and I are always traveling for the podcast. We were just in Nashville filming a few episodes there, and let me tell you, the food was incredible. I had the absolute best appetizers I've ever had. There was this dough ball and these steak skin potatoes. It was incredible. But let me ask you this. Do you ever think about your place back home when you travel? When you're gone for days or even weeks at a time, you can list your space on Airbnb so it works for you instead of just sitting empty.
And if you've ever considered listing your space, but you weren't sure how you'd manage everything while you're away, well, that's exactly where Airbnb's co-host network comes in. With this, you could partner with a vetted local co-host who has hosting experience and can help take care of the important details for you.
A co-host can manage the reservations, communicate with guests, and handle the on-site logistics so everything runs smoothly while you're traveling.
If you have upcoming travel, you probably don't think twice about your home sitting empty, but you could bring in some extra cash while you're away.
I kid you not, a couple years ago, before I had all of the rooms in my house filled up with roommates, I actually listed a room on Airbnb, and the entire process was genuinely so easy. The extra cash was amazing, and I was genuinely just so surprised at the simplicity of the entire process. If you're trying to make some extra cash on the side, I couldn't recommend Airbnb more. If you're ready to host but need a little bit of help, find a co-host at airbnb.com/host.
Who do you think should manage their own portfolio?
I think there's a lot.
A lot of people.
It's really interesting. People are like, oh, well, you're a financial. Easy point. I think Jack should.
Yeah.
A lot of people think, oh, you guys are financial advisors. You must think that everybody should hire a financial advisor. No, not the case at all. There are a lot of people out there that are incredibly capable of managing their own portfolio. We actually say for folks that are just starting out, while you're building out in your 20s, 30s, really until your assets hit a critical mass to where complexity enters in and you have $500,000, $600,000 invested. There's so many great resources out there with YouTube channels and blogs and articles, and self-management is not that difficult. And perhaps AI is making it even easier because now you can get real-time feedback on real questions you have. Answers aren't always right, so you want to make sure you kind of understand that. I think that a lot of people can self-manage up to that point. But generally speaking, one of three things happens in your life. Either the gravity of your decisions is so great that you feel uncomfortable making the decision alone, meaning like, okay, if I make a 10% boo-boo on $10,000, it didn't change my life. If I make a 10% boo-boo on $1 million, okay, that's more significant. I don't know what I don't know. You know, my tax return used to be 2 pages long and I had my full, now I've got a different compensation structure. I have a rental property. I have all these other things going on where complexity has happened, or I'm just so busy, stuff is falling to the back burner. Meaning like, I know I'm supposed to rebalance, but I just haven't had time. Or I know I'm supposed to think about my allocation, but I haven't looked at it in 2 or 3 years. I think if any of those three things happen, that's an indication maybe I'm not at the point where I can self-manage. And a lot of times it's not even people who can't do it. It's people who aren't able to do it based on their current station and circumstance in life.
The fourth one I'll throw in there is because we have some pilots that are clients.
Yeah.
That I told them in another life, you should have done this for a living. Because I look at it, I mean, they become clients. Well, they prospects first. Their asset allocation, superb.
Their portfolio is 10.
You see they've run all the Monte Carlos. They've done all the tax planning. You're like, you guys are geniuses. You're brilliant. And then, and I'm honest enough when I was doing prospect calls with these guys, but you don't really need us. And then they let me in on, you're right, but I'm worried what happens when I'm dead. And I'm getting old enough that I don't want my wife or my spouse to be concerned about who takes us out. So we've actually had people hire us who are doing a superb job of self-management, but they just wanted us, we were their insurance policy in case they left, and they wanted to make sure their spouse
And their children
had somebody in the background that could, that thought like they did about money.
And what should those people be investing in overall?
I mean, we love index funds, low cost, well-diversified, broad index funds. I think if you looked at the portfolios we manage, the lion's share of those are there. Now, there are areas where we do think that inefficiencies exist, where maybe an active type fund might make sense. But for the vast majority, low-cost index funds. And the self-managers that are young, that are just starting out, I think things like target retirement index funds are a great solution.
The reason Bo gave the game earlier, we love index funds because we don't talk about this a ton on the show. It's just the market, because of how fast information travels everywhere now, it's hard to think you have knowledge that somebody else doesn't have. So I think just buy the market, that's why when he talks about efficiency, like if you could truly do a trading strategy that generates 100+% guaranteed a year, it would disappear so fast. I mean, it's like because
everybody
do. I mean, we've even seen it because we really did have people present to us the crazy arbitrage that you can do on sports betting, and it's true. You really can make great money for a moment because their systems are so smart that they'll start limiting your bets as soon as they start realizing that you're playing those type of arbitrage trades, the sports betting sites. It's the same way with normal investing too. If you really had the better mousetrap, I think the things.
Yeah. The exact reason of what you're saying is what has prevented me from putting a meaningful amount of my portfolio onto a strategy like selling covered calls. Because every smart person says that the market is efficient and that there is no way to get 185%.
So just buy the index and save yourself the hassle.
It's still, to me, the logic does not make sense. I would love to be presented with an argument aside from just some theory that the market is efficient and you can't get it, with actual math and data suggesting why I could
look at the SPIVA research. All these, if you could be an active manager that is just trouncing the S&P 500, go look at the SPIVA research. If you go to SPIVA, was it spiva.org or whatever is, but it shows you managers will beat the S&P, but not consistently.
I think they probably have. They're probably trading huge amounts of money, which is that's
the other problem.
Anyways,
that's a whole nother problem.
I think that let's discuss this afterwards at dinner because we're doing dinner afterwards, and I would love we'll say if they're right, if I'm right, or if we just agree to disagree.
Jack's gonna cut back in tears in his eyes.
Yeah,
I was wrong, guys.
I think it's actually freeing if we tell the general public that it's okay to buy an index fund.
Oh, 100%.
Even if you have millions of dollars, it's okay to buy index funds because even there's still some sexy exotic stuff you can even do with index funds. Graham and I had conversations, really cool things that are out there down the road if you're trying to get creative with borrowing money and other things, but you can just start your foundation still on just buying the general economy.
And I think a lot of people are surprised to hear that even folks like decamillionaires who have tens of millions of dollars invested, a lot of them invest the money the exact same way as folks who have tens of thousands of dollars. Low cost, well-diversified index funds.
Should they be invested the same way?
It depends on the unique circumstance, but I think in a lot of cases, yeah. I know for a lot of the folks that we work with, they're doing the exact same thing. Buying low-cost S&P 500, well-diversified, appropriate cash, appropriate risk metric.
So here's an interesting theory. I think if you have less money, depending on age, obviously, let's just say a young person who has a lot of money, a young person who has little money. The person who has less money should probably be a little bit more aggressive because to them, you can't really do anything with $10,000.
So what's your definition? Like if you don't think the S&P is aggressive? You think only the Qs? What do you think?
Yeah, you could be more tech heavy. You could maybe have a couple stocks that if they end up doing well, more risk capital.
He's going to say like NVIDIA, Hood.
But wouldn't you argue that if you
there's
have
some recency bias to that analysis?
Well, you'd say if someone has $20 million and you'd say, oh, well, you should have tax-free muni bonds. You should have, a little bit of this, a little bit of that. International index fund, stuff that's more oriented towards capital preservation because once you have $10 million, you've won the game. There's nothing in your life that for a normal person that you want that you can't afford. But if you have $10,000, you can't raise a family. You can't afford a new car if you need one. Let's say your car breaks, you might have a hard time transporting yourself around the city. you still need to work in order to afford the things that you want. Someone with $10 million does not. So like it's reasonable that they would go into capital preservation as opposed to the other person going into more
But the
like
S&P
of a growth.
is not capital preservation. I mean, look, it's not wild out, but it's also not capital preservation.
I would ask the risk of not being a successful investor is greater for folks with smaller sums of capital or lower incomes. That's why the person who has a smaller income but a lot of time and they're only able to save, I can only save $1,000 a year or $5,000 a year. It matters for that person that $5,000 grows and does well because they are really, really counting on it for that to be multiplied through compound interest over years and years and years and years. If they say, oh, you know what, I need to swing for the fences, I'm going to put all of it in NVIDIA or an app or fill in the blank, and it doesn't pan out, I would argue that was more.
Got some behaviorally too, because I mean, I have a great friend, came to America, and he starts making good money. Started some businesses here in the United States, starts making good money, and he asked me how investing works. And I was like, let's dabble into let's get you in the S&P 500. We open up like a Fidelity account, set up a contribution. I kid you not, it was probably 2 months into it. He calls, he sends me a text or calls me, I can't remember, and he's like, you didn't tell me I could lose 12%. And I was like, no, it's part of the process. It's going to be A-okay. Don't worry about it. So I found out he shut it down. So he only did 2 months. But they were decent sums though, because he was going to dollar cost average some pretty good chunks because he has good money and he had some good savings. So these were 2 decent tranches that he put into the market. Fast forward 5 years, we're still good friends. He comes to me and he goes, I think I need to fire this thing back up because I looked at this account and Brian, this thing's up like 60%. And I'm like, yeah, this is the way this whole works is that, you put the money in, but you can't look at it daily. Mm-hmm. And that's what I worry if you put something too aggressive for somebody brand new to the money-making process and how the economy works, they get discouraged. And for a new person who doesn't know how economies work, what feels risky in the short term is actually your best advocate and success vehicle for the long term. And what feels safe in the short term is actually detrimental to you in the long term. That's what all these people, I grew up in a household, we didn't have money, but my parents were great savers, really good savers, really disciplined. I get my discipline from my parents, but they did CDs. Mm-hmm. CDs will gut you with inflation and everything else. If you don't understand the value of actually making your army of dollars work, you're doing the hardest part of the discipline, but never getting the part of letting your money do the work for you.
So we've been pretty open about how much we love our team here at the Iced Coffee Hour. And when we were looking to hire Gavin, he wasn't just qualified, he was eager to learn about the job, excited about the podcast, and you could just tell that he wanted to be here. And that's what really made him stand out.
And honestly, that is everything when you're hiring. You want a candidate who's passionate about your role, but you can't get that insight from a resume alone. Unless you post your job on our sponsor, ZipRecruiter, because right now you could try it for free at ZipRecruiter.com/ICH.
And ZipRecruiter has this incredible new feature that shows you the most interested and qualified candidates first, so you meet the right people way faster.
And candidates could tell you in their own words why they're interested in your job, so you're not just guessing on who's actually wanting to be there.
Seriously, guys, it is absolutely no wonder why ZipRecruiter is the #1 rated hiring site on G2.
Find candidates who really want your job on ZipRecruiter. 4 out of 5 employers who post on ZipRecruiter get a quality candidate within the first day. You could try it for free at ZipRecruiter.com/ICH.
Once again, that is ZipRecruiter.com/ICH. Meet your match on ZipRecruiter. Real quick, do you remember that doctor's appointment you were supposed to make a while ago? The one that's been sitting on your to-do list for weeks, maybe months? Look, maybe it's just an overdue annual checkup, or it's the weird rash you keep Googling, or your dentist reminding you it's been 2 years since your last cleaning. Trust me, we've all been there. Booking a doctor's appointment has always felt like such a hassle until now.
That is where our sponsor, ZocDoc, comes in. For those unaware, ZocDoc is a free app and website that allows you to search and compare high-quality in-network doctors, and then you could instantly click to book an appointment.
You can filter by insurance, location, and medical specialty, and you can also check verified patient reviews so you know exactly what to expect.
And then once you find the right doctor, you could see their real-time availability and then book a day and a time that works best for your schedule.
And appointments made through ZocDoc happen really quick, usually within just 24 to 72 hours of booking, and sometimes, yes, you can even score same-day appointments. So finally, stop putting off those doctor's appointments and go to ZocDoc.com/ICE to find and instantly book a top-rated doctor ZocDoctor today. That is ZocDoc.com/iced. This message is sponsored by ZocDoc. Thank you for sponsoring the episode.
What are some of the biggest mistakes that you've seen people make?
Well, not saving, I think, is one of the most common you see across the general public. Just never actually getting started saving or putting something aside, living at their means. Because everything we're talking about is precipitated upon the idea that I'm going to defer a little bit of my income, my pay, my whatever today for some greater outcome in the future. And a lot of people don't even make it that far.
I want to see the horror stories.
Well, the other thing, you see them, I mean, and the stats show it too. I can't remember if it was Schwab, Vanguard, one of the big investment houses talked about how much 401k money is just sitting in cash. Do you know how disgusting that is to think about how much money in an asset you can't even reach until you're in your 50s to 60s is just sitting in cash? That breaks my heart. I think that's a huge mistake. We see that all the time because a lot of people also don't know when you do rollover transactions, it's a two-part transaction. You transfer from your old job to your new job, but then the second transaction, you actually have to invest the money. A lot of people go through the hard work of transferring, but then it just sits in the cash reserves or the stable value and never gets invested. That's disgusting too. Not saving, not letting your money work. I'm trying to think of the other thing.
I've got two horror stories for you. One, not knowing when you've won the game from a risk standpoint. Tell the story. You know who I'm talking about.
I won't give too many details. We had somebody that was in our life that and I saw their network. I mean, because they left some stuff on the copier machine one time.
And so that's what you do when you see someone leaving papers there. You're
you're just trying to clear it off. You're like, holy cow!
Okay.
No, but it was a very successful. This gentleman had a small business. It was very successful. Well, he started off as it was more of a food industry job. He had enough. His son comes along and convinces him, hey, use some of that financial success. Let's get into real estate development. And they got into doing real estate development and now realize Pops is set for life. I mean, and by the way, Pops has done some good things. He owns commercial real estate. He's got all these things going on. Well, they start getting into, residential developments and they took on more and more debt. And unfortunately, they put up, I knew the commercial building that we had some affiliation with them. It was debt free. It was completely. But a building can be debt-free, but if it's promised to the bank
as collateral
on some other deals that you do, and that's why when I used to work with professional athletes, the personal guarantee was the thing that gutted most of these guys is because they don't realize what they're signing on to when they sign those personal guarantees is that, and we watched this multi-generational family that had millions gone to nothing. And essentially,
end up losing the buildings, losing all the assets. And they just did not recognize, hey, we've won the game. We don't need to take on additional risk. And then we have
don't run up the score.
This is a horror story. One of our recent guests on Making Millionaires, we sit down and kind of do this, have this conversation with them. They had a financial advisor who had this unbelievable deal that they ought to get into, and you just give us some money. And what ended up happening is the advisor said, hey, we're investing all this money in this development in Texas. They did not live in Texas. And turns out the advisor just fleecing them, just taking the money, never actually invested it, ended up losing his license, and it was just this horrible thing where they lost hundreds of thousands of dollars from a nefarious actor because they believed him and trusted him and didn't actually know where their money was.
I mean, we've had cases, because we've been doing this decades now. I mean, I had somebody who convinced a widow with their 401k money to buy a bunch of equity index annuities. That was, fortunately, because those things have look-back periods, we were able to go and unwind it and fix it, in kind of like the nick of time. You can imagine, we've done some things to help people out.
Another retired couple, paid off house, prior financial advisor was trying to convince them to do a cash-out refi, to take all that money.
Go put that money in the accounts with him.
And go invest it and also buy a bunch like insurance annuity products out of the equity in their paid-off house. And they were already retired with pensions. It was...
Yeah, from a risk standpoint, that was less than fiduciary for sure.
Did not make a lot of sense.
So managing $2.2 billion, who are the best investors aside from pilots, and who are the worst investors?
I think engineers tend to be like very good. If you work in like a pragmatic field like that, engineers tend to be really good. Accountants, people that are in finance generally understand how money works. But it's really interesting. I do think, and Brian said this earlier, I think there might be like a savings gene that we're born with. People that just understand Because you would be amazed at all the like different and wild vocations where people can be very, very successful, even if they're not the attorney, doctor, engineer, that sort of thing.
On the stereotypical high income careers, now look, I have clients that are in this field. So I don't want you guys to write me and say, I'm in that field. Why would you say it? I'm good with money. Yes, y'all are good with money. You work with us, you're a client. But I am amazed at how few attorneys we have as clients. Now we do have attorneys as clients, so don't mishear us. But I'm one, if you look at engineers, accountants, teachers, attorneys, doctors, because we have a lot of doctors too, and we pick on doctors. Doctors already get picked on a lot.
But there's what I think is interesting with medical professionals. There's a wide disparity.
They also have a target on their back.
There are some that are like unbelievably astute and incredibly good at managing money, and there are some that are unbelievably egregious and make horrible decisions. It's a wide.
I'm trying to figure out if attorneys' personalities just don't lead to a lot of. I mean, because obviously there's a lot of wealthy attorneys. Don't get me wrong, but seeing them in practice working with financial advisors, I don't see as many. We do have some doctors. We work with a lot of doctors too, but I think that they have the uncomfortable thing is that they go from tremendous debt to making great incomes. So there's entire cottage industries trying to sell them products to kind of lock their money up in a lot of ways too.
And I think a lot of people that have the most success are people that are able to, I'm going to say build wealth slowly, but like build it consistently. Some of the things where it doesn't always turn out great. Professional athletes who like sign a big deal, big contract, but it's relatively short-lived. People that inherit a lot of money from a first or second generation, big windfalls. Hey, I sold a family piece of business, or I sold a business that was not liquid, but then it became liquid. Windfalls are also an area where it's kind of touch and go in terms of how well they're going to steward that.
Good ones, blue-collar businesses.
Oh yeah,
they crush
small
it.
Business owners.
The small business owners, they crush it, especially when you can get in there. That's the ones that I get the most want to high five after I walk out of a meeting on, because when you see their tax structures and you see their account structures and you show them the tax savings on certain strategies that you can do, because listen, if you're a small business owner, because you know what happens with small business owners, they go from they're paying taxes, but then one year they actually hit it where their income bounces, and then they realize. And they go meet with the CPA, and the CPA is like, by the way, this year you owe $75,000, plus you owe an underpayment penalty of like $6,000 or $7,000, and that's just in the first year they hit it. And they're like, what? And I paid all this tax already, and so you can imagine they already have a relationship with taxation that they don't love it. So if we can go in there and show them through just good retirement structures and other things, or even business structures, that we can clean that up, they love you. You can imagine it's like I said, high five moment.
When it comes to investing, I'm curious because Vanguard now predicts lower than average returns over the next decade.
I saw your Substack and I chuckled to myself.
What
you have
do
to know,
think?
Graham. I chuckled when I literally went to, because every year, and if you go, we could probably go pull the tape because we react to that every year.
Yeah.
Vanguard.
Well, one of these years, they're going to be correct.
Vanguard tells us, you know what you ought to expect from the market going forward?
But it seems
about 3.8 to 4%.
Yes,
they tell you that every year.
Realistic.
Every year.
Does it not seem?
That's got to be the easiest job. I want that guy's job. I want that guy's job.
It's always back coming out of the Great Recession. We saw some really, really good years: 2009, 2010, all the way up to 2012, and then 2013. I think the market made like 32%, and they said it again. All right, market is recovered. Poised for below average returns. And they say it over and over and over again. And at that point in time, you would have suggested, man, well, doesn't it look like this? Look at all this stuff going on. Look at what's going. It always, quote unquote, looks like that. And yet it doesn't manifest. Now, could there be a period of underperformance?
Yeah.
Perhaps. Yeah, that could be a thing. But is there something going on right now distinctly that would suggest the next period is going to be underperformance? I don't think so. They literally said 10 years ago that over the next 10 years, you're going to average 4%, 5%. If you look at what the broad markets have done, it smoked it over
17 to 20%.
Yeah,
last
like
6
it
years.
smoked it.
Every year, there's typically a 14 to 15% intra-year up and down anyway. And then if you think about what we've seen historically, like broad markets like the S&P that we've already had all these conversations on, they typically do what's called a V-shaped recovery. They will either get overpriced really quick or underpriced really quick, and you see snaps. It pops, like we call it the rubber band effect. So that's why if you just dollar cost average, I know it's boring, I know it's not sexy, but if you just consistently buy, you get to capture all that stuff. It's a great volatility protector from yourselves is just being consistent with your behavior. The difference is like real estate, because I know you have so much background in real estate. It's more of a U-shaped recovery. It's not uncommon that you'll see the real estate market not do V-shaped recoveries. They're much slower moving. And I think that's why sometimes we have trouble, or at least the public does, differentiating that different things act completely different. And that's why when Vanguard tells me 3.8 or 4.8%, I'm always like, that a moment in time. I mean, last April, were we down 20%? I mean, it was, so if you were basing decisions off of that, I think you would drive yourself crazy.
But I also think it's like the weatherman, right? If the weatherman predicts a beautiful sunny day and it rains, you get pretty upset. But the weatherman predicts a rainy day and all of a sudden it's shiny, everybody's in a good mood. I think that's what
I've often thought. They've had their thumb on the scale as we're going to get you 4.8%, and then, voila, another year we got 8% or 12% this year. And
it's best to set expectations.
That's right. Under promise, over perform.
Yeah. Well, speaking of overperformance, what do you think about investing in Pokemon cards?
There's a lot of people
I watch
that do
a lot
it.
of content on that, though, by the way. I don't do it myself, but I've watched all those seasons. I'm fascinated by the collectors.
And what's wild is like, so my brother, he has, him and my nephew have kind of gotten into it, and they'll do the thing, do the packs, and he's opened a couple packs that had like some very valuable cards. And he's actually shown me how they have everything like cataloged by like what it is, how much it is, what the RO, and it's wild. Now, it's a collectible like anything else. I would not call that investing. That would not be my nomenclature, but it is a collectible that does have the ability to increase in value over time. No different than other types of collectibles that can increase in value over time.
I've always wondered. Now, look, I'm putting the disclaimer out there, but it's just like, I'd be curious, and maybe somebody knows this and they put it in the comment section. Like, Elvis, now maybe because the new movie came out, it's back, the market's back up or whatever. But I've often wondered, because that audience is aging out, are his collectibles like still worth as much as they were? Because I often wonder, like, because collectibles, I have to believe, is there some ebb and flow on the age of the people?
Yeah,
exactly.
correct.
That's the inefficiency.
Well, that's why they're saying
taking advantage
right
of.
now the future collectible is going to be Justin Bieber and Taylor Swift.
Oh, really?
Yeah.
Huh. But I would imagine their memorabilia is already.
It is, but imagine
valuable,
in 30 years from now when
sure.
a lot of those people have a lot of money and maybe they're not performing as much.
Well, I think it's like Pokemon was a big thing when I was a kid, right? And it seems like there's been this new resurgence that now young kids these days, it's still a big thing. So I don't feel like if it were going to be a collectible, it seems like it's going to be a long time for it.
But you realize you are getting to the age now where things are you're going to see the boomerang.
It's just starting to go
is
again.
Because things from your childhood will now become the hot commodity just because of you are the age of, you're the parents, the generation of kids. Consumption is profitable. So there are people who are out there creating markets to take advantage. You'll see the movies, the music, everything is going to be catering to your group to when they're creating all this creative content.
Let's rock and roll.
So what percentage of a portfolio should be allocated to Pokemon cards?
I mean, look, if you want to, because we let people do speculative stuff. So if you want to dabble with 3 to 5% of your portfolio, go knock yourself out. That's more, but it falls back to the Jack category of hobby. I mean, because that's what I'm not picking on you about that. It's just, but you said you get fun out of that.
I do get fun out of it. Yes,
I'd say less than 5% of your liquid portfolio would be okay to do something if collectibles are your thing or individual stocks your thing or covered call option strategy is your thing. I would try to limit it there.
Here's what I found really interesting is that there's a theory out there that says that young people are not buying houses because houses are so expensive. So instead, they're putting their money in collectibles like Pokemon cards, watches, and cars. And that's why a lot of those things are going up in value. Because think about it. Maybe buying a $600,000 house is unobtainable. Buying a $20,000 Pokemon card, you can't theoretically obtain that. Or buying a $80,000 sports car.
But the thing, can I tell you the only problem I have with collectibles is kind of like, because I went through a watch phase myself. Now it seems like the wealthier I get, the more gizmo I get. Instead of looking at the luxury watches. The thing nobody ever talks about is the market drag cost to actually turn what the market value is into liquid value. Because you usually have to go through brokers. You typically have to, or a trading site that's going to have some type of trading cost to it. So the market, and we all get frothy and excited about it, but if you actually, I think it took into account all the costs that you'd have to turn that into liquid cash, I don't think it's actually as valuable or as people say. I think it's great if you sell that. Like, I think Mr. Golden probably does a great living being the marketplace for that stuff because it's a pretty nice rake on that, doesn't he? But I mean, if you're thinking this is how I'm going to build my wealth, it's the same thing if you're trying to sell watches or jewelry. The market is very inefficient on what the costs are going to be for you to turn that into liquid cash.
Yeah, and they're all unique products, so you'd want to feel pretty confident you had the right one, right? Not all Pokemon cards are designed the same, so you hope that you buy it for $20,000 today and it's worth more in the future, but it's only worth more in the future if someone else is willing to pay more than you paid for it. I would tell that young person, hey, if you have $20,000, instead of doing the Pokemon card, if you're going to set yourself for a higher probability of success, go buy $20,000 of the S&P 500. And you have a higher probability that in the future, that S&P 500 will be worth more than it was when you purchased it.
But I do want to give one exception is that, because I've had two examples. We had a client of the firm who was making six figures trading Disney pins because he was just an expert at the market. And there are a lot, since it's such an inefficient marketplace, he'd go find pins, in whether it's eBay or elsewhere, and people not know what they're worth. And you go basically steal them. It's kind of like your story.
But that's an active. It's
not stealing, by the way. It's just, he knew the knowledge.
Yeah.
Well, also, because you always hear people say, "Don't buy boats. The best 2 days to own a boat is the day you buy it and the day you sell it." But then we had a client that also made a great living trading boats. But once again, it's because he was an expert. It's back to my point earlier, bringing it full circle. Sometimes it takes 10, 15 years to develop the expert where you can see stuff that nobody else can, but you have to take into account there's a skill set or a time component that also went into that you've built a skill that the market doesn't have. And that's why it's easier just to buy the index if you can't go out there and spot that. And if you don't know if you're the expert or not, then you're probably not.
You're probably not the expert.
What are the riskiest investments that you both have personally?
Well, I would argue like commercial buildings. Does that count as risky? That's not a risky thing? What are you talking about?
Triple net commercial real estate.
You know what I mean? It's I would argue that kind of stuff is risky. We're small business owners, right? There's a lot of volatility in small business, so that would be
investment.
Look, I know what you are getting at.
Where
Look,
have you
I will
put your
tell you,
money?
I dabbled in crypto. I dabbled in crypto for a while. I did it for about a 3-year stint, and I lost money on it. So I quit because I was trying to dollar cost average into it to see if that would work, and it was just. The thing that bothered me about Bitcoin...
but you did the exact same problem like the other guy you were telling about, and then 4 years later, like,
let me defend my position. And I will admit, I was exactly... If I'd have stayed the course, I'd have done okay. But what I didn't like about it, Graham, was the daily volatility. It didn't feel like an investment. It felt like a speculative play based upon how much play was every day. I mean, when you have 4, 6, 8%, every day on your trading, that's weird to me. I mean, it feels like the market swings, and we still, like right now, I'm barely keeping up with Bitcoin anymore because when I gave off, and the other thing that scared me off from it was when the government put that line across the top of your 1040 and made you basically, yes, no, are you dabbling with cryptocurrencies? I felt like they were setting a trap to a degree because a lot of people are out there marketing, hey, this is outside of the government. You don't have to do it. And I'm like, no, taxation's not outside the government. And if you're not checking that box, yes, you don't think Coinbase, or even if you're putting this stuff in vaults and stuff, there's things, I don't know if you're keeping up with some of the geopolitical stuff. They just had a big announcement that a lot of the Iranian Bitcoin and stuff has been frozen. How do they know about it? When we had all the protests up in Canada, they froze all the Bitcoin of those trucks. How do they? That's what you're told these things about, and I just don't think it's as disconnected as everybody thinks it is. And I worry the volatility makes it feel more like a speculative play than an investment. And I'm more into the investment. Emotionally, maybe it's because I come from an accounting background. I don't get my highs from riding the speculation.
What price did you sell Bitcoin for?
I mean, it was probably in the mid 30s. It was in the mid 30s. It's around 35,000 probably.
So you would have doubled.
Yeah, I would have doubled from here. I would have. But I have no regret.
You would have done okay.
I would have done okay.
You would have doubled.
I mean, but realistically, I could have tripled. But now I'd have been back to double only in because we went up to 100. We went up to 100. How high did we go? 120?
125.
Yeah, 125. So, I mean, but look how crazy that ride is. I mean, I would be, because the other thing is, I already told you the Apple story. I mean, I still kick myself on that one because emotionally I started getting reactions. Now, look, as a percentage of my assets, it wasn't even a rounding error of 1/10%, but yet I was mad that that it was down. And it's the Apple. I mean, I should have held on, but you don't know. And that's why probably the craziest thing I have now is I do have close to 7 figures in one stock, and I've just told myself I'm going to ride or die with
What
it.
stock is it?
Well,
should I say? Should I say?
Yeah.
Should I say what it is? Is it okay to say?
I think you can say because you've owned it for a long time.
Okay. In 2018, I got my first Tesla. I got the Model 3. I got the Model 3.
I knew it was Tesla.
I got the Model 3 in 2018, and I had one of the early versions. It was because I remember I'd ride by the coffee and cars, like where all the exotics were here in town, because there's a lot of fancy cars here. And I watched all these people with their Lamborghinis, right? Because the Model 3, when it first came on the scene, people were like really excited. Now we see them everywhere. I mean, I can walk outdoor and probably we can throw a rock at 12 of them. But when they came on the scene, and this is the first time I drove a car that people were like ripping their necks trying to look at you, and everywhere you pulled up, people would want to talk to you about it. So I was like, holy cow, this thing is pretty magical. So I put $25,000 into Tesla back at the beginning of 2018. You can imagine it's done pretty well.
So you're at close to 7 figures now.
Yeah.
Now, if you sold some
I'm not gonna
covered
sell
calls
it.
on it,
I'm
'cause
not
it seems
gonna
like you're a
sell it.
little overweight in
Hey,
that
can I tell you the
stock.
other thing I
can
am
make
excited about?
3%
It's in a Roth IRA too.
Is it
No.
actually?
It's in a Roth IRA.
Yeah.
So I feel
So that's
like
the best investment you've ever done.
It's pretty good. No, the best investment is hiring Bo.
There we go.
I hired Bo
There
in
we go.
2008. That was probably the best. But yes, from a individual stock, it's been the best investment.
Incredible.
And I've just decided I'm going to ride or die with it at this point.
There's no plan. There's no goal. It's not if it hits this amount, you're going to do something.
No.
It's just like money for the sake of money.
Because even though that is at that level, it still as a percentage of my holdings is just it's not enough to move the needle.
And so for you don't have a story like that.
Well, I have one similar, but it's not as exciting. I also own Tesla stock. Mine's not quite 7 figures, but I was going to do. Mine was a content play when they very, very first announced the Cybertruck. I knew how much Brian loved his Tesla. I'd ridden it a bunch, and I was like, oh, you know what I'm gonna do? I'm gonna see if I can create some content. So when they announced it, I started just dollar cost averaging, buying a couple $1,000s of Tesla every single month, right? And my plan was, by the time the Cybertruck actually came out, I was going to create some content around, this is how Tesla paid for half my Cybertruck, or whatever the thing was. Well, it ended up coming out, and it was not as interesting or exciting to me, so I decided not.
We decided we're not Cybertruck type
Yeah,
people.
I was like, I'm not really, but I was like, well, okay, I've got all the stock, and it did what I thought it would do. It was certainly more than enough to buy the truck. I was like, but I'm going to hold on to it for some of the same reasons Brian said. I'm like, I've got it. I don't really want to pay the taxes. I don't want to trigger the gains. So I'm just going to kind of consider that a lifetime holding. So I guess technically that's my riskiest investment.
My wife forbid me from buying the Cybertruck. She thought it was so ugly. I couldn't do it.
And what's the most that both of you have lost on an investment? Because it was a speculative play.
I mean, that Tesla's been all over the place. But I haven't lost.
That's
I
not.
didn't lose.
You've made a ton of money off of it.
Right.
What have you lost money on?
We did options for a while. This was not a ton of money, but it was a great learning experience. We did some option strategies way early, back when I got the CFA, very early on. This was
we were like, let's flex the muscle
in
on
the
this
early
investment.
2010s. I thought I had the market figured out. So I came up with some option strategies we could deploy. I was the strategist. Brian was the capital back then. And so we doubled
in like a month and a half. We thought we were genius. The worst thing that happened with a strategy is you actually hit it the first time. So we turned 5,000 into 10,000 like in a month. And we were like, we are genius. We're like, Bo, we're going to be so rich.
And so then I was like, hey, you know what? Okay, this was good. I have another idea. And I came up with another idea. And this is what's so frustrating. We were going to buy some long calls, and then we're going to buy some puts on.
Well, we can say it's probably because it's kind of fun to think about as Netflix.
Yeah, we were.
Wow!
So we bought calls on Apple because we were bullish Apple,
and we bought
puts on Netflix because we thought Netflix was overvalued. Right?
And it was. We were right.
And here's what's wild.
But this is why you have to be worried about the time degradation.
I think
it's
it was
a real thing.
That's why you sell them.
It was like 6-9 months, something like that. And I think Netflix was trading at like 300 or something at that point in time. And the time ended up running out. Options ended up expiring, worthless because it never. And I kid you not, it was like less than 6 months later.
I think it was less than 2 months.
2 months later, it dropped down like
stock lost like 30 or 40%,
$70 or $80 a share.
It was a huge drop. We would have made a fortune
if we would have been 2 months.
But we realized that you can be right on a trade and still not make a dime because the time element of doing contracts. It can hurt you because you can be spot on, but markets aren't efficient in the short term. They're very inefficient on the short term. You can be spot on that something is overvalued, it's a bubble, or whatever the case may be. Now, look, Netflix turned out to be a great company in the long term. That's one more, cap, feather in the cap for being a long term investor is that even if you would have ridden that stock down the 40% where we were right on the overvaluation, they caught their stride and went right back up because they were still, there's been frothiness. All companies deal with that. And that's why I like being a long-term holder.
But that's why the lesson I took away from that is, as an investor now, since that point until now, I have a really hard time betting when there's a time constraint. If I'm going to buy something or invest in something, I want to be, okay, this is a Warren Buffett mantra again, being a lifetime holder of that thing. If I buy this, I don't care what it does, this week, this month, this quarter, this year, this decade, I'm going to be okay holding it long-term. That's why most all bets, even if I was going to do some sort of option thing, I want to be long. I want to be bullish on whatever that is, because it's just so hard to get the timing right when it comes to investing. The market has a way, at least in my experience, of making us all, even the smart ones, look like fools.
What are your thoughts right now on the real estate market? Because here's a few other stats. 75% of U.S. homes currently for sale are unaffordable with the median income household, and 97% of the U.S. are considered unaffordable by historical standards.
It's hard out there.
We just did a show that's doing really well because I think we hit a chord with something. Should you own or rent? And we went deep into the data, and because something I've been on the rooftop screaming, because
it's frustrating.
Frankly. I mean, because I want people to be able to buy a house, but I also want to I want people to get good information so they don't get themselves in a bad. Somebody give them the expectation that they should buy a house because that's the next thing successful people do, and get themselves in a bad situation. And what I've been telling people, and I'd encourage you, please go check out that show we did because it was a super deep dive. I'm not going to be able to do it justice with this quick answer, is that for a lot of people, the market made 50% in like a 3-year cycle on residential construction. If you think about what houses went up. So to think that reversion to the mean, because like I said, it's not a V-shaped recovery with the real estate markets. They typically are much slower moving. I think you're going to see real estate likely might underperform for a period of time. I mean, you're even seeing it like a lot of markets now have inventory levels exceeding 4 months, which is something that we didn't see that long ago. We're starting to feel like that it's a buyer's market more so, but it's not there yet because also the interest rates went up to a point where 50% more, your monthly payments went up 50% just off the interest rate alone. So don't feel forced to do it. Do it because it's actually something that makes sense for your personal life.
So from an investment perspective, we would argue primary residence are not an investment. It's not an investment decision you're making. It's a lifestyle decision. You need to make that decision based on when it makes sense for you to buy a home. So if you're someone who's thinking about getting into real estate as an investment opportunity, well, then it comes back to the same tenets that real estate has always had. Location, location, location. What's attractive about that market? What type of property is it? What do you hope to get out of it? What are you're going to pay cash? What are the financing options? Can you cash flow it if it goes bad? I think you can still investigate it and look at it. And I think there still can be a compelling case to be a real estate investor. It's certainly harder to do now, specifically in the residential side, than it was 10 or 15 years ago.
And elongate your holding period. So you can hopefully the time will smooth out any craziness in the pricing.
Yeah, it's crazy what I'm seeing right now. Throughout Los Angeles, a lot of properties are selling now for the same price that they were between 2014 and 2018.
That's wild.
Depending on the
market. You've
market.
also highlighted there's a lot of crazy stuff on restrictions on how you can use the property too, which I think that kills the market as well.
It does. But even in Las Vegas, I'm seeing a lot of sales that when people bought from 2021 to 2023, they're selling at the same level, if not slightly less.
Yeah.
So these are people who bought and they're losing money on a sale, holding it for 3 to 5 years. Some of them.
So don't feel forced to do it because trees don't necessarily have to grow to heaven. That's the thing. I think we all know real estate's good, and especially the levered debt side of it. When things are good, it's great, but it also can hurt you if you have to use other people's money to afford whatever you're trying to do in real estate. You probably can't afford real estate. That's why we love real estate. We've talked about it. We've done some decent amount of commercial real estate. But it's more of once you have a good financial stability underneath you, so that if your place sits empty or you have to make big repairs or put a new roof, it doesn't need to stress the system. Too many people try to get in way too soon.
Is now a good time to flip a coin for a house?
Oh my God!
It still seems that he did it.
Yes.
He did it. He was like, hey, and it was $1.9 million, right? Like that was how much the house was.
Y'all said y'all are friends with him?
Yes.
Right? I wouldn't flip a coin.
He's got to come see us because I want to meet his person because his personality is the polar opposite of my. I'm too risk adverse to ever do anything.
He would probably do it. He did a whole financial audit with Caleb Hammer.
What's the most amount of money that you would flip a coin for? Would you flip a coin for $1,000?
Yeah.
10,000.
With you guys? Yeah.
100,000.
How many views do you think we could get if we did a coin flip for $10,000?
You flip a coin heads?
No, not 100,000. I would do 10,000 because I know it would be going to you and you would invest it.
Okay, fair enough. So I just thought that someone could do that for $2 million. Just seems
y'all are great y'all are much better at the content space than us. Do you think sometimes when you do those big transactions that do the views cover the loss?
No. He spent.
Do you want me to call him? I'll call and ask him what's the most you would flip for.
Oh no, we're not doing that because
no.
He just flipped for a house.
And I'll also ask him.
I am
how
better
much
than
do you
I
think
deserve
you
on
made
things, and I'm just not crazy enough to do it.
Yeah.
Okay.
Let's see.
We'll see if he answers. Yo, what's up, bro? We're on a podcast right now with the money guys, and you came up, and we had some questions. Okay.
Did you really flip a coin for a house?
They don't believe that you flipped a coin for a house, so we need confirmation you flipped a coin for a house and lost 1.9 million.
1.95 million on one coin flip. It's actually real, and I don't own that house anymore.
So
my friend, the guy I lost it to, gave me a 𝗪𝗧𝗪𝗧𝗛𝗧, but then I crashed it, so I didn't get much out of it.
So if you would have won, you would have gotten cash, or what would you have gotten?
Cash. So he put up cash for my house, so I would have gotten 1.9.
So would it have really gone down? Like if you flipped and you would have won, or would it? Do you think?
He'd have given you $2 million.
Gosh, that's just crazy. That's a different life.
What's my best friend? Like it's would you trust your friend that's sitting next to you to pay you $2 million?
Yeah, but if you're my best friend and we flipped a coin for the house, and I felt like I was going to take your house, I'd probably be like, dude, I know. Don't worry about it. Well, 2 out of 3 or something.
Did the video at least make enough to compensate to make that a worthwhile investment of $1.95 million?
No, you have to understand this. Listen, ready? It's not like I invested 1.9 million. I invested in the opportunity to make 2 million. The video didn't. This is facts. First of all,
facts.
It's not about the video ROI. Maybe the video ROI made realistically 300,000.
Okay, it did make 300,000.
Opportunity. So what? I really I made 300,000 on the video, and a 50% chance of making 4 million is worth 2 million. So I made 2.3. It just on paper it don't look like that.
That mathematics only works if you do it over and over and over again. For a single outcome, you can't do that same sort of statistical
You wanted
math.
to do it again?
You have to flip. If you were to flip 100 times, and 100 times you were to do that, in theory that your math would hold. But one time...
A bunch of nerds about it.
All right, last question. What's the most you would flip a coin for?
Honestly, as much as I joke about it, that was mildly traumatizing.
Okay, there we go.
All right.
Today, in my life position today, I would do 400,000. I'm not comfortable doing it anymore.
Hey, can I ask a question though? Because and you don't have to disclose this. What is your liquid assets, like investments? I'm just trying to figure out how deep 1.9 was into your bench.
My assets. This is funny. You're gonna like this. Hold on.
I just want to know. I need to have context.
My assets right now. Well, we have maybe we have a crib that's a few million, a bunch of floors. But I emptied the bank account. No investment. This is my only asset right now. This fucking parlay that just hit for $1.4 million. I got to go cash it in 2 days.
Holy crap! What did you bet on?
We put 600,000 on PSG to win 2 nights ago. So that's why I'm in Paris. We went to watch the game and cash.
Name 5 players on PSG.
Couldn't name one.
Oh
okay,
my God! That tells me everything I need to know. That is wild, man.
Wild.
Congratulations!
That is so awesome. Thanks for answering the questions.
Appreciate it, man.
That's wild.
There you go.
That's wild.
He's as real as they come.
That's
brutally honest. Too.
He's
a guy you could trust with your life.
Yeah,
he's a man.
But what if someone else Hey, I'll flip you for Bo's life? He'd probably take that. You know what I mean?
That was all. I mean, holy cow!
Man.
I mean, but you know what? In friend groups, I would probably want to hang out with somebody like that because I'm always looking for opposites. Because I'm wired so the opposite of that it'd be interesting.
I always love going to the casino when my buddies go in the high stakes room. I just get to kind of watch them. I get utility from that.
Oh, it's exhilarating. We went with Steve Will Do It into one of the back rooms, and we saw there was a person there betting $100,000 a chip.
That's wild.
And in a hand, you could lose $100,000, make $100,000. He was up a few $100,000, but it was just, to me, I got the same feeling as if I were doing it myself.
Oh, yeah, but it wasn't your money, which
It
is
was not
great.
my
You got
money.
to same experience, not the same cost. That's why I like to have friends that have boats.
So, in order to afford a property, how much money must you be making these days?
For a primary residence? Oh, I think it depends, right? It's interesting. You mentioned the affordability of housing. I think right now, if you look at the median home price in this country relative to the median income, it's like 4.8 times. It's the highest it's ever been. So housing is at as unaffordable of a rate relative to the median household it's been. So I think it's very much person dependent. In our opinion, when it comes to buying a house, we think that 3 things should hold true. You don't have to put down 20%. I think that a lot of people say you have to put down 20%. When your first house, you don't have to put down 20%. You can put down as little as 3 to 5%, depending on the type of loan you're getting. We do want you to be in the house at least for 5 to 7 years, but we don't want your total housing costs to exceed more than 25% of your gross income. So I think that's where the barrier lies. Like, what income do you need to be able to buy a home? It depends on the prices of homes in your area that you're looking at, and you need the income that would substantiate the housing is not more than 25% of your gross.
There are 2 asterisks I'd put with that. If you live in high cost of living area that has public transportation, you might be able to boost that, juice that number up 8% because you don't have a car loan. Most people have car loans. The other thing is if you're in a high flying career, like let's just say you're right out of school, or you're an attorney or an accountant, or somebody who's your career trajectory over the next 3 years is going to go up. You can use some projections to go probably, to skew a little higher.
And I don't think you have to own a home. I think there's this conventional idea that you have to be a homeowner, you can be incredibly wealthy, incredibly successful, and build towards financial independence as a renter. It's a very personalized decision based on where you live.
Look at the market, because like some markets, you're crazy if you buy. I mean, we have a number of clients. The Silicon Valley, it's cheaper to rent
way cheaper
than it is to buy. And then you just go retire somewhere.
So why are people buying there?
Well, I think some people use it as a holder of value. You know what I mean? If you have...
I just told you the majority of Americans, the only wealth they build is in their house. And so it's like a force.
And also you have outside resources. The international money, there's, corporate money. There's others that are using real estate as a holder of value, and you're in competition with that.
And if you're, you get married, you have kids, you want to start a family, you want to set roots, your family is there, and you think, oh, well, I want to be a homeowner, but I'm not going to leave this area because everyone's here. There's a lot of things that pull people towards that, but if you're going to make that decision, you need to recognize that it can be hugely detrimental to your long-term well-being if it's a poor financial decision.
And I don't know if I might have misunderstood your question, is because I think rent is so cheap in those places because a lot of those people have mortgage. I mean, if they have mortgages on the property, it's sub 4% because then the prices were probably a third to a quarter.
Yeah,
because it wasn't that long ago that these property was much more affordable.
That's very true.
Renting is easier.
Do you still think real estate's a good way to build wealth?
Yeah, I mean, it'd be crazy.
In like your primary residence? Yeah, I would say so.
Over the long term, that's where your holding period. I know we said our checklist is 5 to 7 years. Me personally, right now, just giving an opinion. I love the rule 5 to 7 is traditionally right, but I think you have to elongate your holding period because there could be some crazy volatility with just buying.
How long? Because the average person, I think, holds their house for 11.8 years.
12 years, yeah.
I think that would probably work. I think it's at least 10 years.
But why does it build value? Well, most people buy a home, it's a levered property, right? So you're borrowing money, you have a small amount down, but the entire value of the property on average is going to increase at about the rate of inflation. So if you assume the rate of inflation is somewhere between 3 to 4%, my home value is going to increase every year at 3 to 4%. And because I'm levered, I am now amplifying the actual rate of return. So if my house, for me, cash on cash return can make 8, 10, 12% over a long time period, then yeah, it's going to build wealth, but you can't eat your house. So I wouldn't bank on that being the way that you're going to pay for your retirement living, but it shouldn't surprise people that wealth can still be
What about
built.
this argument that you're going to have a lot of boomers going into these nursing homes and having to sell their house and all of these homes flooding the market at a time when millennials cannot afford it?
Well, you never bet against the system could change to a degree. Think about this. I've heard several proposals. What if all of a sudden, capital gains right now are capped at $500,000 on being tax-free for married couples, $250,000 for individuals. They could index that for inflation. They could change it.
Should.
They would you'd probably have a lot more houses hit the market. And but because it would be tax-free gains, potentially indexed, people might be willing to give a little bit. That can maybe make affordability even help out a little bit because more houses would foot because it's a supply and demand thing
That's
too.
what I'm going to say, supply and demand. If all these houses hit the market, it's going to naturally drive down prices as inventory increases. As prices come down, well, now all of a sudden it's affordable for millennials or for Gen Z or whoever.
And then even the SBA has now made where residential construction qualifies for some of these favorable deals that they offer where these lines of credit are dirt cheap. I mean, I don't think residential construction has always been considered eligible for some of those SBA loans. So I know there was a huge headline that came out probably 4 months ago. I sent to every one of my home building friends. I was like, hey, you might want to go check this out. It's just like when we bought this building, the SBA was a big part of the driving factor of that is because, sometimes, they're trying. I feel like, now look, I don't think the government is overall a creator of economic growth, but I do think that they can help subsidize and, spark things to a degree. You need to pay attention to what those incentives are.
I'm going to show you this. What do you think about this as a strategy to pay your mortgage?
I just last week bought $250,000 of Stretch. And the reason I did it, one was just to sort of go through the experience, which I enjoy doing. But the second is I have monthly obligations. And I said, well, I have a 1.75% 30-year mortgage, right? And if I can, instead of paying down that mortgage, put it into an instrument that pays me 11.5%, that's 10x my mortgage rate. I'm essentially making money by taking the money, putting it into Stretch, getting 11.5% and paying off my 1.75% mortgage.
And where is that yield coming from? Since again, you're not selling Bitcoin.
Yeah, the yield comes from us issuing shares typically into the market. So on the back end, what we're doing is MSTR are common, right? High liquidity stock, the highest liquidity stock in the stock market, period. We're issuing shares and we're using that proceed to basically pay off our dividend. And as long as we're issuing shares above net asset value, that's accretive to our common shareholders and it's good for Bitcoin and it's good for Stretch.
But haven't we seen this story play out though with others? Because we reacted to some content where people were going out there and buying massive houses and then doing was it stable coins or other things or these strategies, and then they all kind of they imploded upon themselves.
I remember that. I saw.
I could probably
it
go
was
pull
Terra
our
Luna because I remember seeing a TikTok where someone said, "I'm going to borrow from here." And then I'm going to make 20% a year from over here. It's free money. Why is everyone doing this?
It's back to kind of our conversation. What's funny is how full circle, because we're not unique. We all are trying to figure out how we can make money easier than everybody else. But it's back to if the market really lets you do that, I just don't believe it's possible.
Well, but let's step away from the actual investment that he was suggesting, that one. Yeah, if you're someone who has a 2.5, I mean, he said 1.75, but 2.5, 3.5, 4.5% mortgage, it's a really difficult thing to justify paying that mortgage off early because that capital likely could be better utilized somewhere else. Even if you're just buying a boring old index fund that's going to make, 9, 10% annualized, if I can make 9 or 10% over the long term and I'm only paying over here 3.5, 4.5, even 5.5%, his strategy still works. It's not 10x, but it's still, a 2x rate of return or whatever that number may be. I don't know about the actual investment he's suggesting, but the idea that if I have low interest debt, I shouldn't be super aggressive in paying it off makes all the sense in the world. It's why in the financial order of operations, the very last step, step 9 for us would be prepaying low interest debt. I leave that as long as possible so my money can work for me as hard as possible.
I get nervous when somebody talks about how stable or safe something is, but then tells me it's going to make 11%. I mean, it doesn't pass the sniff test.
Or
I've been around long enough for the Bernie Madoff conversation. I mean, I've been doing content since 2006. And I remember one of my favorite shows, it never was really popular, but you were involved with this too, is I pulled Bernie Madoff's regulatory filings. There were so many red flags in there. If you just go read his ADV.
What did you see?
Well, it was just like
when you deposit your money, you deposit it to Bernie Madoff securities, and then the statements you received were from Bernie Madoff securities, and then the reporting that he gave was there was no check and balance. There was no Fidelity, Vanguard, Charles Schwab, and there was certain disclosure you were signing off on. There wasn't any sort of mark-to-market reporting required. It was
the small accounting firm that was the accounting firm listed. It wasn't one of the Big Four at the time. I think it was still Big Four back then instead of Big Six, but it's none of the household name accounting firms that you typically see with public companies or big companies. It was just all kind of weird stuff that he was doing that just, the only reason people were doing it is because a little bit of greediness that, hey, this guy was making greater than 10% every year. And it felt like it was somewhat guaranteed. So why not get in there and get some of that?
You turn a blind eye when something seems too good to be true and you experience it for a moment. You let your rationality and logic fly out the window.
I can understand how the S&P 500 is average 10% a year because there's risk and reward tied to it. When somebody touts something on its safety and then tells me the same return as the S&P 500 that has risk associated with it, it makes my spidey senses go.
So what do you think is the ideal risk-free return? Are you just looking at the treasury and we're talking
that's
3 to
what
5%?
most people, we're talking 3 to 5%, depending upon where we are with inflation in the treasuries.
Really good proxy. If whatever you're making on your cash and a good high yield is a pretty good proxy for what the risk-free rate is. Because I would argue that's about as close to risk-free as you're going to get.
Yeah. Now, in terms of retirement, how important is it that you own your house?
We have a lot of clients who, for their entire working career, they owned a home, they retired, and they said, hey, I want to go be in Florida. I want to go be in Arizona. And they sell their house, and they decide, hey, I'm just going to rent in different markets and that works totally fine. So I'd argue for them, the necessity of home ownership doesn't exist at all. They have a very small footprint. They're able to kind of bounce around. That's totally okay. People can do it and be successful. And other people love having a home base. Hey, I'm going to buy my house. I'm going to have it paid off. I'm going to live here. This is where I'm going to age into a ripe old age. There's not a right or wrong answer. Personal finance is so personal. It depends on the unique thing that you're trying to accomplish.
I do like people to be debt-free in retirement, but it's not a necessity. The thing I always try to remind people, we have this concept, we talk about the wealth multiplier. That's why I get heartbroken when I find out a 32-year-old is paying down their mortgage that's 4% instead of funding their Roth IRA because they're debt crusading, versus I don't get mad when I find out like a 58-year-old is paying down a 2.5% mortgage. It's because
Assuming they have assets.
Assuming they have assets is because they might be deciding that the arbitrage or the delta on what they're making is just not worth it. The squeeze of the fruit or the risk is not worth it when what they're trying to do overall. So I like de-risking because I kind of alluded to this earlier. When you retire, meaning you're living off the money you've now saved or a pension or whatever, it stresses you out when you see all this geopolitical or economic stuff because, a lot of us, I think we have this cope that we do is that when the market goes down, we're like, it's okay. I'll just put down my nose. I'll work harder. Or maybe I'll even save a little bit more to hedge against it. When you leave the workforce and you go into full retirement, you don't get that comfort. Now you have to say, holy cow, I'm not only living off these assets, but I'm watching the volatility decay, what took me decades to build. So it just hits different. So if you can do other things in your life, like take out debt and other things that create obligations or things that you have to do, it's a truer version of freedom in retirement.
Is $1 million enough to retire in 2026?
Can you live off of $40,000 a year?
How old are you?
60 years old.
Okay, 60 years old. What that means is Social Security is likely going to come your way. 60-year-old with a portfolio, if you assume somewhere between a 4 to 5% annual withdrawal rate, you're going to be able to pull $40,000 to $50,000 off of that, assuming you never bid into the principal. But in reality, in retirement, you can get into the principal.
Did you say put Social Security on it too?
So then I was going to say, once you have that $40,000 to $50,000, then you put Social Security on top of that, which for a lot of folks is another 30, 40 grand.
4 or 5 grand a month, yeah, maybe.
What if you're 40 years old?
No.
Will $1 million be enough when you
to retire?
No, to retire.
No.
You want to retire at 40.
He's going to answer like a financial planner. I'm going to
say,
you want to tell you why I say no? It's because and I'm not going to call them out by names, but there have been other fire movement people who've retired super early, like 35, 40, and then they've come back and they're really good people and they've done great content. But if you're being honest, once they start having kids and they realize, holy cow, these kids are a lot more expensive than I ever thought. And they usually have to go figure out, because it's just they didn't have enough life figured out to truly call yourself retired at 40 years of age, because a lot of life is still going to happen to you. I think a lot of times in retirement, the die needs to be set to a degree so you kind of really can measure out what your expenses are going to be in the future. If you're doing this at 35 or 40 years old and you don't, like for you, Jack, you're not married, right? Don't have kids. Do you know how much life is going to change for you? If you tried to say right now, I'm done, I've got enough. I just don't know that you have enough of your life tied down.
What is the realistic retirement amount for someone who wants to have a family of 4?
I want to make sure I understand your question. Are you asking, can a 40-year-old with $1 million retire today, or can a 40-year-old today get to $1 million by retirement?
Can a 40-year-old with $1 million today retire?
Yeah, I think that'd be hard.
And so what is the realistic
Because health insurance too.
What is the realistic amount that someone who is 40 years old needs to retire to support a family of 4?
It depends on their living expense. I know it's a really hard answer to give, but it depends on living expenses. Some families of 4 can live off of $3,000, $4,000 a month. Some families of 4, it requires $9,000, $10,000 to live. Well, the retirement portfolio necessary to satisfy both of those enterprises, very, very different. So it's hard to like give like a hard and fast number.
I wouldn't even sniff around it unless I had $3 to $5 million.
At the age of 40.
Yeah, 40.
Yeah.
What would you say FU money is?
10 million.
Yeah. We talked to I think we kind of covered it because I think 10 million is a good number because your money earns what is a great life, even if you took very little risk.
What if the market underperforms, like Vanguard says?
Yeah, but 10 million or in general?
When that's the beauty of the 10
million.
million is because it's so, even if you use the safe withdrawal, I mean, if you use the, risk-free rate of return of like of treasuries, I mean, it's still $400,000. I mean, you're talking about $400,000 or $500,000 depending upon
hard to spend
what money.
$30,000 a month.
What do you think is the ideal safe withdrawal rate?
What age?
What age?
40.
I mean, 3.5%.
3.5.
What is the
And I wouldn't retire
So-
with that. I would want to do still run a Monte Carlo
So
simulation
you know what's
and stress
interesting?
it.
I've done so many calculations on this, and it determined that if you want to retire at the age of, I can't remember if I put 36 or 40, it was one of those, and you live to the age of 95, assuming that average lifespans are going up. It told me that to be able to account for the Great Depression, so basically you're retiring the day before everything collapses.
Right. Sure.
It said 2.75 to, I believe it was 3.2 at the very most, a variance between that. And it said you could actually do a little more if you had a year of expenses in addition to that saved in cash.
Yeah, well, see, but I think with 3.5, you're still young enough and able-bodied. You can go subsidize it if you really got squeezed.
And I want to be, this is something important for the audience to hear. In our mind, safe withdrawal rates are napkin math, right? So like what we're doing
It's not
is
a
we're
real
talking
financial
about
plan.
I would never tell someone, oh, based on a 3.5% draw rate in this pot of money, you can retire. What I'd want to do is say, okay, you want to retire age 36. How much are you going to spend from 36 to 50? What are you going to spend from 50 to 65? What are your, like, I'd want to actually not just factor in an estimate of the things you think that will happen between 36 and 95, but realistically put some teeth to it. Okay, you have daughters, great. Are you going to pay for their wedding? How much do you think a wedding is going to cost in today's dollars? What do you project that wedding's going to? How often do you replace automobiles? Do you replace them every 7 years? What kind of automobile? Okay, you want to travel. How often do you want to travel? Do you think you'll be traveling when you're 93? And we would try to, and this is what we do for our clients, get as granular as possible on the things that we can realistically estimate. And then we would reverse engineer using Monte Carlo analysis. Does this get there? Because what actually ends up happening is it's not a static 3.5% safe withdrawal rate every year. There may be a season where the safe withdrawal rate's 9.5%, 10%, but then something changes, spending changes, lifestyle changes, another income source enters, and then the safe withdrawal rate drops down to 2% or something like that. So it's way more dynamic in practice than it is in like academic theory around safe withdrawal rates.
How common is it that people run out of money in retirement versus save too much?
But it's always, that's the save too much. Because I think I'm now at the stage with money that you try to figure out, you look back over your life and go, which were the dollars that actually turned into this dollar and which decision was it? And it was the culmination of all the good decisions together that I don't have regret that without a doubt, I'm not going to leave this planet broke based upon all the good stuff, but I don't have regrets or feel like I left something on the table. I know that's not really answering the question, but I'm trying to get to the mindset that I think you have to be careful because so few Americans actually save what they need to for retirement, even though we showed you with our wealth multiplier, it would take very little, just a little bit of discipline when you're younger to do it. That people aren't even, like 60-year-olds don't have, what was it, 100, and when we did the book tours, like $110,000 was the average, investments for somebody in their 60s. That's way below what they should be. So since we have a problem that nobody has the money, I don't want to say there's, the risk is you're going to have too much. That's just you're a rounding error statistically. That's probably not the message I'd want to put out.
And then on the flip side of your question, are there a lot of people that would run out of money in retirement? What often ends up happening is most people aren't like living life, everything goes to zero. What ends up happening is it kind of goes down and they begin having to make sacrifices they might not want to make. Hey, I had a house, but we can't afford this house anymore, so we got to sell it. Hey, I was living on my own, but I can't afford the bill, so I'm going to have to move in with family. And if it gets really dire, it'll devolve in a situation where, hey, I don't really have any assets, but I've got Social Security. I'm going to figure out how can I live on whatever my Social Security check is. I think that's more the reality, because I think the number was something like 60% of retired Americans right now, the majority of their retirement income is Social Security.
Yeah.
Some
crazy
number around
stat
there,
like that.
which is sort of a wild thing to think about. So how often do people have to make concessions in retirement they didn't want to make? I think that probably happens more often for the average American than we realize, because I think the average American is not preparing for retirement the way they ought to.
What about lifestyle creep? Do you see that as being an issue over time? Is just spending a little more, like doing the $200,000 cruise, and then pretty soon, I got to do the $500,000 cruise?
Well, look, lifestyle creep gets a bad rap. This is a hot take. Lifestyle creep is not bad. We actually want lifestyle creep. We want, for most people, to have a nicer lifestyle in our 30s than we had in our 20s, a nicer lifestyle in our 40s than our 30s, nicer in 50s than in 40s. That's your lifestyle creeping. What you can't let happen is let your lifestyle outpace your savings, outpace your building. So long as you're continuing to save and continue to grow your pot of money and to continue to build for the future, there's nothing wrong with you buying the nicer home, buying the nicer car, going on the nicer trips, assuming you're doing all the other stuff that you're supposed to. I think far too often people forget that second part and they just let the lifestyle creep.
I would like to give some old man knowledge, though, on something. You know, you hear, we talk about on our show, the hedonic treadmill is good things that happen in your life. You should try to spread those out as much as possible so you can squeeze every ounce of dopamine and goodwill or good experience from it. And then bad stuff you should stack up. And what I mean by that is, like, you always hear about lottery winners, they go broke. If lottery winners would learn, hey, let's start off with 10% or something of what you learn, what you win, and maybe you buy a house and that's it. But usually they want to go buy the house, they want to buy the vacation property, the speedboats, they want to buy the new car. They do it all, and then they find out they're numb. All you did was you shot your system because you numbed it. You didn't give yourself any time to absorb and process it. So I always tell young people, as you start making money, don't shoot for the global, international business class. Do it to the 9 when you're in your 20s. Go do something, go do Europe cheap, because you're at the stage where that's the best. So that way you save something, leave a little bit meat on the bone for your 30s and 40s. And if you can think about your life and creating success and achievements and experiences that way, I think you'll find that you have an appetite for, and your happiness and fulfillment will be much better than if you just go run yourself in debt, do the most exotic and luxurious vacation. You might be setting yourself up for just a life that is just not set up right because you did too much too fast.
What's the best thing to spend money on?
I mean, I look, I'm at the stage where experiences, family, I'm the sentimental guy that tells everybody they should be having a gazillion kids because I only have 2, but I also waited 5 years into my marriage to have kids. And now looking back, because my oldest is graduating, leaving the house, I wish we'd had more. I mean, because it's just, kids they're hard. Now, I don't want to misplay because you're in the messy middle. You have littles in your house. It's easy for me at my age to say it's not hard, but I love experiences and memories and doing things like that. Travel is awesome, especially when I can get loved ones. I'll bribe the heck out of my oldest daughter to get her to do vacation with us.
You have to bribe her to go on vacations?
No, he just meant he wants to go on vacations that she wants to go on.
I don't mind. I planned on, and here's a compliment to her. She graduated high school. We took her to Paris to celebrate graduate. She graduated college. I said, where do you want to go? And I'll write a check, and we've even had more success. I was thinking she was going to choose. She just wants to go to Disney. So, I mean, I was shocked because we go to Disney all the time. Yeah. So, but it showed me that that's where you worry about lifestyle creep and stuff. People, if you want to know the secret to happiness is the people that you surround yourself in. All the research into happiness usually comes down to spirituality, relationships, friends, not doing commuter traffic and things like that. That's what it's not necessarily the exotic house and car. The biggest thing that shocked me once I got really what I could think would people look at my net worth on paper, they'd be like shock and awe, is that I realized how empty the stuff was. I mean, and you and I've talked enough that I think, have you experienced any of that? I mean, it's the money.
No, but I
could
really
buy
don't
any car I
buy
wanted
that
to.
much.
I know,
Yeah.
but that's the thing. You don't buy that much because you could buy anything. You could buy any exotic car. You could buy any exotic watch. I just find that I don't get much out of that stuff. I mean, and that's what, it's funny. We've done coverage on this. The billionaires look like they're almost homeless. It's the aspirational people that are typically out there, blinging it up.
Yes.
Because they're trying to they want people to look at them. I think there's something when you have it, it doesn't feel like it's doing as much for you. And you almost are a little embarrassed that if you wear some of those trinkets.
Yeah.
I think the best thing to spend money on is stuff that creates memories and experiences. My favorite thing to spend money on is stuff that creates convenience. I just love convenience in my life. So if I can outsource something or add some sort of efficiency, I'm willing to spend money for that thing.
Yeah, that's what Jack has really been trying to hammer in me. I remember this stood out recently. I was comparing, it sounds so dumb. I was comparing two dentists. One of them was expensive, but was really close by, could do everything in one visit. The other one was half the price, but I'd have to go back twice. And I was, because they had to do
also
x-rays
explain.
Let's do this one.
Let's talk. So how much was the more expensive one?
Like $300 more expensive.
I would go to the one that could do it all for $300.
And then the other one, how far away was it?
Oh, an extra 15 minutes.
15 minutes one way?
Yeah.
So
but it's
30
two
minutes
visits
twice.
versus
Yeah,
one.
two visits.
Two visits on two
Correct.
separate
Yeah.
occasions. And then one is how far?
8 minutes away.
8 minutes away. So, and one visit and it's $300 more.
If I can afford the convenience, I'm going to go with the convenience.
Yeah, I went with the more expensive one.
Yeah.
Great experience.
Your time is
No
worth a lot of
regrets.
money.
Yeah.
The value of your time is worth a lot. That's the other thing I've learned is that, when you're younger, you are literally trading your time for wages. And as you get older and successful and you realize, holy cow, I don't have that much time left, you understand the value of your time.
Start
So you're
trading your
willing,
money for time.
you definitely trade your money for the time. And that's why the experiences and other things is because it's not forever and it goes quick. I mean, I called a dear friend of ours. His birthday was yesterday. And we talked on the way in and he's like, yeah, man, it feels like the years go faster and faster the older you get. He's in his 70s now. And so I cherish the time I get to spend with people I care about. And that's why I'm on the old man tour now. Like I go on a spring training with my high school buddies. I go, I'm trying to get my college buddies. It's an act of Congress to get my college buddies to get together. But then every year I go on a golf trip. I play golf once a year. It's with my old neighbors from Georgia. We go down to Florida and we play rounds of golf together.
Love that.
It's important to make time for memories.
Graham, you should show them your portfolio.
Yeah, let's do it.
Now you guys are going to react to all of Graham's investments. Obviously, no numbers. Just say what you
After
think.
seeing how did you keep track of what you gave on the previous score?
Yeah,
if you don't, you gave Jack a 7.5.
7.5, 8.
Graham's
Because
gonna get
I can
5.
see how Jack and Graham are. They're going to be mad at whoever
one gets a
loses is going to feel slighted.
I already know you guys are going to agree more so with Graham, and it's okay.
But we
why
gave
are
you a
you
high
doing
score.
that?
We were not.
I'm not upset.
Yeah.
Like I'm actively choosing every day when I wake up to have a portfolio that looks like this. So I'm completely.
You're way ahead of the curve.
I'm completely unbothered.
By the way, I'll go ahead and tell you, if you want us to give you a prospect kit, we'll give you a prospect kit right out in the lobby as you leave today.
He just said he's one of those lifetime do-it-yourselfers.
I know it.
I'm open to anything.
I love it.
Okay, now you can open up and see all the different accounts.
Here's the
So
first.
is this the biggest one?
Here's the first investment account. Okay.
Oh, this is all of it. This is him playing around.
All right. There's some stuff in
Robinhood, you're basically, that's your speculative play account.
Yeah, for the most part.
a lot of
Jack's getting in on this.
Go to the big stuff.
Well,
go to the big stuff.
It's just an interesting to note. Here's a $1 position. Here's a $5 position. Here's a $6.
Those are probably the free trades that they gave
Let me
them.
see this.
Those
There's
are the
a-
free trades, aren't they?
There's a $6 position in US dollars.
There's a $7 position. There's a $12 position.
What?
So
Yeah,
one of
it's
the things I'd probably do is clean up a bunch of the single-digit dollar positions.
Oh,
in
some of
here.
those I can't close out because they're worth so little that I tried to sell them and they won't let me sell them. So I
It's-
actually have to go and request this thing from Robinhood.
Or donate
for
them or
to-
something?
Yes, for them to get rid of them.
0.035 share. Okay,
Yeah,
so that's
just ignore those.
so-
Those are
but
Go look at his big stuff.
Hey, look, we're assessing the whole. You have to look at the whole picture. That's the thing.
Your big assets are the same thing. I mean, they're in tried and true stuff. I mean,
Yeah.
so
And you could be a little
resemble. But I think this is making our point because everybody here, we have decent investment portfolios, everybody at the table, and we're all buying the same similar market type stuff. And that ought to be something for the audience to take a big note of. Is to be like, here we are having all these pontifications on the investment marketplace, but if you actually look at what money we're going to live off of in the future, it's the broad markets.
So you just have like a number of different accounts that could likely be consolidated. I'm sure there's some strategy to that.
Are we talking about the investment accounts?
Yeah, there's like just a couple, like there's a couple of different.
Did you have like
investment accounts
affiliations or do programs with some of these things? Because you do have a lot of different companies.
Yeah, I use them all, and I've just kept the investments in there, and they've grown since.
Is that because you were
2017.
curiosity, or you did something with these companies?
No, a lot of those were me just trying out different brokerages. Because back in like 2017, I would go and make accounts with every single brokerage out there. Yeah,
yeah.
And I would use
does
them.
Does that not drive you crazy?
It drove me crazy. I had accounts at every single brokerage.
Because the older you get, I want more simplicity in my life.
I'm merging a few of these, but I have different accounts for different purposes.
Okay, you've got a health savings account. Love HSAs, right?
Yeah.
You have like $3,600 of cash in your HSA.
I just forgot to invest it.
But that's
he's going to have a hard time
truthfully,
beating
but
7.5, 8 with a bunch. You know what I mean?
I know.
But it is the same. I mean, because I was going to pick on because I was like, man, that's around. No, that's account size. That's actually a pretty decent size.
That should be
left
cash.
a lot of cash.
But there's no positions in this one.
So is that just cash?
It's your Roth. There's no positions in here.
It didn't probably translate over from that
really
brokerage.
Want to see that one.
Yeah.
Okay, we'll make sure. That's what I was talking about.
That's @𝗪𝗧𝗡𝗃 in the Roth.
Is it all of it? Okay, great.
The entire thing.
Perfect. So that's great. The Acorns account cannot see any holdings in that one either.
Yeah, that's 4 ETFs in that account.
Okay, good ones or bad ones?
Good ones.
Okay.
Yeah. They're all like Vanguardic.
Okay.
Stuff. Yeah.
All right. That's fine. I mean, that's fine.
You don't even classify yourself as an exotic.
Talk about a snooze fest, right?
Yeah.
I mean,
it could be a little bit cleaner. Like, I just feel like there's some account consolidation. Like, if you were a client, I'd be like, hey, why do you have all these different accounts? Why do you have all these different positions? It might be easier to get your head wrapped around anything. And not, because what's interesting is, okay, I forgot to invest that $3,600 of cash. Well, $3,600 of cash can turn into $13,000 of cash just because it did. 13 that can turn into 30. 30 can turn into 100. Like, it happens that way pretty quickly. If you have so much stuff that's hard to keep an eye on where everything is.
It's also easier to compare, to know annualized performance or how well you're doing when things are consolidated. Because you got stuff, I mean, now I'm sure this thing's going to spit out a report somewhere on here where it would tell you, but it's just, there's a lot of scrolling.
Yeah, I have like 12 1099s from different
That's the other part.
And like, does that not like bother you a little bit? Just
I keep track of them all, and then an accountant
Of course
does it
you do.
all,
I think you're naturally good at this stuff, but that doesn't, just because you have a way of doing this, I don't know that I think it's the most efficient use of your time either.
Now, that's a big one. It seems like, maybe not enough to total net worth, but it seems like you're pretty bullish on crypto.
Yeah.
Yeah, but it's still under, I think, 12.
So how much is he up? Does it show how much he's up? Because we don't have to give the number, but do you know how much you're up?
Total, I'm up maybe right now at these levels, like 6%.
Okay.
So
maybe 10.
So
maybe
I'm surprising because it's a decent size holding. To hear you're only up 6% kind of surprises me.
Because I have a lot that I bought in 2017, and then a lot that I was buying in 2021, 2, 3, 4, like more like dollar cost average.
So do you think Bitcoin's going to change the world? Like for the term of
I think there's an asymmetric upside that it will do better than it will do worse.
What about all the quantum stuff that people are out there throwing out there as risks?
Bitcoin would be able to change the way it's secured to be quantum resistant. I don't think it's going to be a risk.
And I'm not saying that's a risk. I'm just
because banks are going to have to update
we all
that
have
too.
These headlines thrown across our feeds, and I just
banks would have to update as well. So it's like, would banking be a risk?
Yeah, it's just a lot of,
and those computers don't necessarily exist yet.
Yeah,
like you have some positions that are like pretty substantial, and then you have some positions that are just very small relative, right? Like
it's more of a wrangling issue for you, Graham.
Like I got some thoughts on that.
Yeah. So, what would you rate my portfolio out of 10?
Remember, you gave Jack a 7.5. I have a number I think you want to say, and I'm curious.
Don't do it because you gave me a 7.5. Just do it independent of me.
I like
but you have to know where the scale is.
I like your overall allocation much better. Like I think it seems to be a more well thought out, more robustly diversified portfolio, but it's a little bit sloppier in terms of like cleaning up some stuff, right? So,
when he says that, I think, I'll let you be because I would skew it. I was talking about the quilt of life. Yours is out of choice, is that you have assets all over the place, different providers. And you said that you went on a journey trying out all the big providers. And I think from a content creation standpoint, that was great. But just ongoing, I would probably try to consolidate to simplify your life so you own more of your time.
And by that, you're saying close down a lot of these brokers.
Yeah, what are they adding value?
If you
don't have a business relationship with them and you don't, then why make it where you have to do more compliance for accounting purposes and more just keeping up with it, worried about access and everything else that comes with having more accounts?
True.
Was there a retirement account in there? I don't remember seeing a retirement account.
There was no.
Was there a solo?
There was just a Roth
wasn't
IRA
a solo
that I
in
had
there?
set up. No.
What are you doing?
I just figured
you want to pay your taxes.
My honest thought was, I think that I didn't want to do a 401k because I just think taxes are going to be going up substantially by the time I retire, and I would rather just pay the tax today.
Okay,
in terms of like a Roth
401k.
Roth 401k.
Which I don't think makes sense for you. But if you're going to take that stance, do a Roth 401k. Because what's cooler than taxable assets? Completely tax-free assets.
I thought about it, and then I was just like, well, I just kind of want access to it now if I wanted to. Maybe
you
that
just said you don't touch it.
So right now,
you literally said you're not touching it.
Right now, you have access to capital. Like we just saw your accounts. You have access to capital. So starting yesterday, it'd be sort of insane not to start building up 401k, solo 401k assets.
You got to give me a rating.
Oh, yeah.
Give me a rating.
Okay, this is what I want to say. I'm gonna give yours an 8. So yours,
I'm only 0.5 higher than
No,
Jen.
I was thinking the exact same number. I didn't want to color his answer, but I was thinking the exact same thing.
A 7.5 because yours feels a little more emotional. And by the way, 7.5 is great.
Emotional?
Meaning you love your portfolio. Like you make your decisions based on emotion. You said every morning I choose to. That's not a negative thing. Your emotion is, I like being
only for a small portion, by the way, as we've discussed.
I completely disagree with that.
And then yours is a little more well thought out, but it's just a little bit sloppy. It could be consolidated. Both of you just are missing some tax opportunities. Like there are like some huge opportunities. So that's not really a portfolio rating. It's more like a financial planning rating. Man, there's some stuff that you could be taking.
So the only thing I should be doing on that though is just not the Roth 401k.
Well, I think there's probably a case made that you could do not only a solo 401k, not only load that up, but you could also look at some sort of cash balance plan, which is another way to defer hundreds of thousands of dollars.
I think taxes are going up though. So like, I don't want to defer anything. Like I'd rather just pay the taxes now. Like I
then you can still do the Roth.
Yeah.
You don't have to go as big as these numbers we're talking about. But from a legacy standpoint, you could still do some Roth planning.
Okay.
Let's assume for the moment that tax rates are going to go up.
Yes.
Do you think that so we operate in a progressive tax system, and so a lot of people think, okay, well, tax rates are going to go up. That seems likely. Do you think that you're always going to be in a position where even if tax rates go up in mass, you're going to always be in the highest tax bracket?
Yes.
I think with appropriate and proper planning, that doesn't have to be the case, only because we have clients that live in that world.
The only thing I will say, because I do think at the level Graham's at, that he is probably going to be in the higher tax brackets, but it's more of the opportunity cost of what you could do with the money yourself versus giving it to the government right now. Because that's really what also we're talking about. Is if you could save a few $100,000 off your taxes now, that's money you get to keep in your back pocket and deploy if you want to. Now, you don't. That's the thing. I still don't have the why figured out for you, because I think that, I would want to have a lot of discussion on what you're trying to build for.
He's too busy to be a real estate professional right now, but maybe at some point in the future,
that's what
if
I
his
could
work
see.
slows down, that he could become a real estate professional, take a bunch of paper losses, and then that's when he could just
I never want to touch real estate ever again. I'm done with that.
You really think you're done with real estate?
Yeah.
Which is so interesting to me. It really is.
Nope. I want nothing to do with it anymore.
What soured you so much?
A lot of
besides the timing.
Yeah, a lot of Los Angeles, the illiquidity of it. Like right now, I'm in the process of listing and selling 2 properties, and the amount of time and work it's taking to be able to get those ready to list. Because I don't want to list a place that's like, not to say falling apart, but sloppy.
But
I don't want people to go in and there's like peeling paint. Like I'm spending maybe $80,000 this month fixing up these places.
Just to get it ready to sell.
Just to get it ready to sell.
Yeah, that's frustrating.
And it's not only that, but it's also dealing with contractors and dealing with what's a staging quote coming in? Are they doing this? That should have been done. I caught a few things that should have been done that weren't. It was different when I was 25 and I had the free time and all I was doing was real estate. It was really not difficult for me to manage these properties. Like I was in the areas anyway.
But also money was so much less expensive. The prices were so much lower. The economics were so different.
Totally. And for my time, it was valuable. Like I showed up every single day to every job site. And I was there at 9 a.m. And when they weren't there, I'd give them a call. Where are you? Why aren't you here? I'd be stopping by like after work. And I loved it. I had so much fun. Now that's a pain in the ass.
Yeah.
Like now I couldn't.
It's a young man's game.
Yeah, exactly. So is there anything you'd recommend me doing differently besides opening up a Roth 401k?
I didn't do the math. Because you had so many accounts, it was difficult for me to do the mental accounting of how much of your portfolio is like risk on, risk off, right? Like I saw some risk off, more conservative positions, but I didn't have like a good asset mix. I'd want to be able to figure out what those numbers were.
Under 12% is risky.
So under 12% is risky.
Yeah, that's basically the crypto.
This is back to our definition
so
of
different
what they consider
definition.
risky.
So I would say like risk off more would be like fixed income, bond holdings, that sort of stuff. Like is your portfolio?
It's 75% equities, real estate, 25% treasuries.
Okay, great.
Overall.
So that's given the size of the portfolio, probably not crazy. Maybe even a little bit more conservative than I would have thought at your age, but not awful. I didn't see a clear performance metric for either one of you across the whole portfolio. So one of the things we like for our clients to be equipped with is like every report they get or even on the portal they can see exactly what their portfolio, the whole thing, all of the accounts have done year to date for the last 1 year, last 3 years, last 5 years, since the day they started working with us. So even though we see the portfolios as they exist today, what was not clear to me in looking at it is how effective of an investor have you been over the last 5 years?
Yeah.
I actually don't know how to create that with Schwab because I had all of my money spread across a few brokerages. But then about 8 months ago, I consolidated everything with ACATS transfers into Schwab. And so it's kind of hard to track my actual performance.
They count that as like your gain.
Exactly. And every time my monthly contributor
they reset it. I mean, essentially in their system.
Because what they do is a lot of these brokers, they focus so much on short-term performance. Hey, we'll show you what you're doing for the day, what you're doing this quarter so far. We want our folks to have a much longer term view. Hey, how much did I start with? How much have I put in? How much have I pulled out?
The other thing is basis tracking too.
You can't toggle principal.
We help our clients because we're tracking all that stuff. We're
Schwab is good about tracking basis.
But if you're consolidating,
that's the part.
Performance is lacking.
Well, they include the principal. Which I wish you could just toggle that off.
Yeah, I wish too.
Yeah.
Charitable giving. I didn't know. I didn't see it. Do y'all ever consider donor advised funds? Because I saw gains in there. You could do donor advised funds if you're charitably minded.
I forgot to look for loss position. I was so blinded by the $3 positions that I didn't look for losses to see.
Well, there's also a lot of. If we'd have gone through every one of your accounts, this would have been a full 3-hour audit. I mean, there's a lot of accounts there. It really was. I mean, it was scrolling.
But look, you're both, by and large, you're both doing the big things right. Neither one of these were dumpster fire portfolios. Neither one of them things would give us a whole lot of.
We could give both of you prospect kits and feel really good about it.
So Jack and I are actually working on a side business because for us to be in front of the camera all the time indefinitely, it's not going to happen. It's not feasible. So we want to build something outside of the Iced Coffee Hour. And we were spitballing back and forth a while ago what good ideas are. And one of the things that we kept coming back to is the fact that people who open credit cards have these rewards that they are either unaware of or they just never utilize. Like there's like a Saks credit and like a Dell credit.
And they all expire on different time horizons.
Yes.
So you have one that expires, you get 2 per month. Maybe you get one every 3 months. Maybe you have one semi-annually, one annually for all of these different websites for different amounts. And so what we decided to do was consolidate every single credit card bonus, credit, discount, benefit all into one dashboard. And then it'll send you notifications when something is expiring according to your liking. So if you want notifications, like a lot of notifications, very little notifications, it'll just kind of tell you based off your preference, hey, by the way, here's a link to Saks Fifth Avenue. Just click it and use this card at checkout because you have 50 free bucks that's expiring in a week.
Yeah.
How difficult will it be to keep up with the rapid changes that take place?
It's very easy. There are already things that exist online that can scrape all of that data and just immediately. Yeah. So it's 99.9% accuracy, the software that we're using for that. But the main idea is that people will pay $900 a year for like the Amex Platinum or whatever it costs, but not use Resi credit that comes $100 every single quarter, $400, or Uber.
That's
because
true.
what I do
I've fallen
all the
I've done
time.
that.
what
all
I
the
do
time.
is at the end of every single month, I'm like, oh crap, I have an Uber credit. And so I just Uber eat some food because even though I don't even need it because I want to use it. Same thing. I forget that my Amex Gold has benefits.
So what is this, a membership thing? How do you, so
it would be a membership thing.
Yeah,
so
so people could link, as of right now, the concept, people could link a few cards for free. To be able to try it out. And then if they want to link more than that, there'll be a small fee with that. But it'll also tell you which cards you should be using for certain purchases. And it'll look through your transactions and tell you how much you missed out in rewards by not using the appropriate card.
And will it update like rotating categories? Like some cards that Discover have
so
rotating?
Also like if you go through the
Correct.
Chase portal with different Chase credit cards, you know how they have like the discounts and promotions tab? So like if you... expiring at the end of the month, you get 10% back at Lululemon up to $50 back total. So $500 total expenditure. So it'll also determine, hey, on this card, you're spending Lululemon quite often, but on this card, if you just click and accept the feature.
Oh, yeah, exactly.
Because
you have to
opt in.
opt in.
You have to opt in for the
And that's the
discount.
thing, when you look at the offers on Amex, there are hundreds of them. And
Yeah,
you
but you
never
have to
go through,
opt
it's
in.
like, oh, Home Depot's offering $5.
And it doesn't
off.
tell
It's
you,
like,
hey, you shopped at Home Depot
It's
and you didn't
restaurants
opt
too.
in.
Exactly.
So it could
I have the
yeah.
Amex
It
Platinum.
could also just link you and say, hey, just opt into like these 30 because you shop at these 30 places across these cards. And then like, it'll just,
Interesting.
So
Interesting.
so we bought the website Extra Dollar, like extradollar.com.
Nice.
I like
So
it.
we're
I'm
working
surprised
on
that
it.
was available.
So we're working on it. So if anyone wants to sign up for the wait list and get first access to be able to try it out, it's extradollar.com.
EX or the letter X?
EXTRA.
Yeah, like actually written out extradollar.com.
$extra. Love that.
Because you get to save an extra dollar.
Or more. Terms apply.
Extra dollar plus. Yeah.
Cool. Well, thank you guys so much for coming on the Iced Coffee Hour. It's always a pleasure. Thank you for the team for all sitting in on this. Thank you for letting us use all of your equipment. This has been such a blast.
I love it. I've been looking forward to this. So.
Mi casa, su casa. We always have a blast, really. And you guys, I love the dynamic. I mean, I think Bo and I pick on each other. You guys
We
also
were
pick on each
joking
other.
earlier. We were saying like Jack and me.
Oh,
That's kind of the way it works.
All righty. Well, thank you guys. Thank you guys so much for watching. We would not be here if not for you. We flew all the way out here. Okay.
The
Flew out
flights
to
were
Nashville.
expensive because gas prices are going up like crazy.
They were expensive.
The flight
but-
was twice as much as it usually is. So if you appreciate that, just hit the like button, subscribe. We'll link to all of your information down below in the description as well.
Thanks, guys. We always have a blast.
By the way, if you enjoyed this episode, we just posted our next one early for members. So if you click the join button, you could literally begin watching our next episode right now. Really hope you enjoy it.